following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of Ninjatrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the Ninjatrader website.
Good morning, everybody. Welcome to Ninjatrader Live. My name is Jim Cagnina. It is a historic day here at Ninjatrader. Joining me live from Long Island, New York, the incomparable Tom Schneider, CMT. Tom, good morning.
Good morning, Jim. How are you doing this fine morning?
Pretty good. Do we agree that it was March 19th, 2024 this morning?
Yes, it's March 19th today.
There's thanks for that. There's so much stuff going on. I'm like losing track of the days even. It's crazy.
Yeah, today is historic for a lot of reasons. I think we'll start out with the news coming out of Asia and Australia, but also for Ninjatrader, like you said, we have three great guests. So it's going to be a jam-packed day, I think.
Right. It's crazy. In the same day on our live stream, remember 9 to 12, everybody, we're going to have Dan Gramza, 10 o'clock. We have Blu Putnam, 10:30. And then batting cleanup really is Larry Williams coming up at 11. So, I mean, what a great, I'm going to learn a lot today for sure.
Yeah, and any one of those guests alone would make it a great day. And now we have three. So we're excited. We can't wait.
Yeah, for sure. So you mentioned a couple of things that happened overnight, Tom. Let's talk about the Bank of Japan. This is the first time they've raised rates in 17 years. I think I might have read. Now it wasn't a massive move, right? It went from minus 0.1 to 0 was their Fed fund range basically, to 0 to plus 0.1.
Right. And these numbers, they're not really numbers that we are familiar with because we raise, or cut 0.25, right? Or maybe half a percent. We're talking about 0.1%, but it's kind of it's not just the raise itself, it's what it means, right? Getting into positive territory. It's kind of a shift for the way they're going about managing their currency and their economy. So I think it's a big deal, but the reaction was kind of odd, right?
Well, yeah, and because and we could take a peek at the chart. Let's take a peek at the chart because you would think it would have been we would have ripped up higher. This is a daily chart for the yen-US cross. Instead, the opposite happened. And when you kind of dig into the rhetoric a little bit, there's some other things to think about. So, as an example, the board votes to ditch the bond yield control, right? Risky asset buying. So that you would favor a rally, but then they went out on a limb and said the Bank of Japan expects ultra easy conditions to stay for the time being. So I think some of that rhetoric kind of caused this big sell-off instead of a rally.
Yeah, and we noticed it. If this is a daily chart, this is a pretty big move. You can see there's really there are some other candles earlier in the year that rival the size, but I don't think those were based on any type of decision that was enacted. I think maybe one of them, but certainly not all three. This is the biggest candle we've seen, down candle in a while, which again was surprising. It broke through its what is that? That must be
that's a 50 simple, and then it's approaching the 20. Yeah.
Right. So 20, it got close to the 20, backed off a little bit. Buyers came in, brought it back up, but it certainly kind of halted that rally you might have seen from the beginning or say mid-February, beginning of March. I think it's a big big turnaround, especially crossing below the 50. That's a big deal.
Yeah, let's not do that. Yes, we can. Let's go ahead and just pull up a 10-minute chart really quickly here. So you could see the big break, Tom. I mean, it was nothing but pretty negative.
Yeah, and when that announcement came, that big candle has big wicks on top, big body, relatively speaking, when you compare it to everything else before it, and then a big wick on the bottom. That's just uh, that was the entire trading range at that point. Now it continued the downtrend, and if we look at this, it blew through S3 on the pivot. The question is, where do you go? Well, you can create your own S4, which happens to be right around where the point of control is now, and it even failed that. Now, that to me is just an extreme move day. You usually see them on central bank announcement days, but if you had told me they would make a 4.5 pivot move, because we started the pivot, right? We went through S1, S2, S3, S4. We got down maybe to S4.5, and now we're back up to S4 or close to it. It's an amazing move.
Yeah, no, for sure, for sure. I mean, we're below the VWAP for I don't want to say ever, but big. So, in any event, a big move down on Japanese yen. Let's let my data here catch back up because there's another central bank that we're going to talk about next. The bank, Reserve Bank, it's called It's called the Reserve Bank of Australia, and
RBA,
they're
the RBA.
RBA is that was that the Bloomberg coin? Is that what you coined it at Bloomberg?
I think that's how they referred to it in the news, right? Just like we call it the Fed, they call it the RBA.
Got it. Well, so anyway, they call it the cash rate. Their actual cash rate was unchanged at 4.35, forecast 4.35, previous 4.35. I didn't read any of the press releases, which I probably should have because my guess is they're in some modified version of English, right? Being Australia.
Right. I think they're in English. You're right.
Anyway, same thing. Nothing. A big break on the Aussie dollar on a daily chart. We broke through both moving averages here, which is another ginormous candle on the downside. So a little bit hawkishness here.
Yeah, and it's interesting when you have these moves that come on pretty much expected news forecast. It meets the forecast. This is really, I think, about what they're saying, right? So why didn't they do more? Well, they need to be confident that CPI is coming down. It's probably not what the market expected or wanted to hear, and that's why we see this move down.
Yeah. So in any event, big. I mean, this is a trend. This is a nice trend down. Ever since this peak high up here, this peak wick. It's I guess that's a really that's a mohawk wick, Tom. This one, you need a lot of like hair gel to keep that thing straight up. But I mean, it's way up there, and not ever since then, nothing but sellers.
Yeah, we broke through two moving averages that were converging. We've seen that in I think other currency patterns. Yeah, I would target that basing action that you have from end of February, beginning of March, about 2 weeks ago, right there in the middle. That might be the next target where you might find some support.
Let's put the rectangle in, Tom. No chart's complete without a rectangle.
That's right.
Anyway, why are we talking about the currency pairs? Well, the currency pairs, these are a great place to trade Forex. It's Forex futures, sure, but you're trading currency pairs, you're trading currency crosses, so many advantages, transparent marketplace, it's liquid markets, highly regulated, many more benefits than just that. So that's why we're talking about it. And there was a big opportunity today. Yeah, there's a big risk today too, but there's a big opportunity last night. Let's keep moving though. Let's go to the main event. Let's go to the E-mini S&P daily chart just to take a peek because I think we did have some an economic release already hit the streets, Tom. Let's talk about that.
Right, and it's pretty much the only economic release I think that's going to matter anyway, which is the housing permits, I believe. But that seemed to give this market was trending down. But you look at this is kind of anticipatory of tomorrow, right? It's not making new highs. It's not making new lows. It's kind of stuck within yesterday's trading range, at least in the body, or close to it. And we were lower today. And then at 8:30 we had a big news report that came out and kind of brought this market back off the lows. But nothing really extreme that would make new highs, new lows off that report. Just kind of give it a little boost.
Yeah, and interestingly enough, I have a volume profile, a daily, right, order flow volume profile that I put on this daily candle, and I started it when we kind of established this new trading range, right? So on March 8th, we kind of March 11th, I should say, jumped up, right? And so now we're in this new trading range, I guess, sideways range, I'd call it. And so that's when I started the volume profile, the order flow volume profile. And interestingly enough, the distance between the areas between the volume nodes, or the peaks in volume, are starting to fill in a little bit, right? Starting to fill in a little bit. And so I think if this market continues to go sideways, then you're going to have a really nice volume profile here over a period of time. Now, anything can happen, of course, but that's why I'm keeping this, right? So I'm looking at this area down here. 5183 was an old kind of point of control, maybe. And then the official point of control is way up here. 32 52 I'm sorry 32 52 34, and then there's a little node here in the middle also around 18. So these gives me areas of interest for today.
And looking at this distribution, you look at the last 3 candles. Well, let's look at the last 4 candles: Thursday, Friday, Saturday, Sunday. That volume that's traded on the order flow volume profile where we've been trading, it's lighter than, let's say, it was last week when we got the CPI number, right? CPI number, there was a lot of volume.
Yeah.
And so that's a lot of the profile. We've traded within that volume gap the last 4 days, and we're not even coming close yet to filling it. So we are filling it, and that's what a lot of times on a multi-day profile chart, you'll see that you see a gap in volume, you see a divot, if you will, whatever you want to call it. The market will want to close that divot. They'll want to even it out. But this just tells me there's low volume in anticipation of tomorrow's numbers.
Yeah, that's right. 203,000 traded so far in the E-mini S&P. Let's take a look at all the economic releases that we're up against today, since you mentioned FOMC. And, the meeting begins today, right? In theory, anyway, they're already there at the meeting room. It supposedly started at 8 o'clock. I don't know, maybe Kashkari got caught in traffic. Who knows? But it's going on right now. We already had housing starts and permits, Tom, and I think we had some data there as well.
Oh yeah, we sure did. And it was good news, right? The forecast for the housing starts and permits was, as I pull it up, it was forecast to be 1.44 million. And these are starts. The actual number was 1.52. So a little bit better than expected. I think that's good for the economy. Month over month, that's a 10% change. It was forecast only to be 8%, 10 plus changes. So that's good news. Building permits. So instead of houses, we're talking about more like commercial buildings. Month over month was up 1.9%, forecast to be up 0.5%. So housing industry, the home builders and the builders in general seem to be getting a little bit of a lift, and unexpected, I would say, a little bit, and that's what the market reacted to.
Yeah, I mean, there's no end in sight. It's a
Yeah.
strong housing market, no matter how you look at it. It's just, boots on the ground in my area. There's cranes and buildings, housing going up all over the place. A lot of carpenters are working right now.
That's good. That's good for the economy. And then later today, not much more going on. We've got, let's see, 52-week bill auction, 20-year bond auction. We've got Treasury International Capital. That's at 4 p.m. And then the usual API weekly oil stocks report. So if you're trading energies or crude specifically, you might pay attention to that. That can give a little insight into tomorrow's EIA report at 10:30. but that happens at 4:30. So right before the session ends, about a half hour before the session ends, we'll get those crude stock numbers from API.
Yeah, and that's a good thing. A lot of people look at that. I just let me highlight this idea. You know, if you're not a subscriber to the API Energy to get that data, um, that's okay because someone shoots it out on Twitter anyway
Right.
within like 5 seconds. So you can get the basic baseline inventory data that way, and that's how I get it. To be honest with you,
Yeah.
I go to my Twitter account. So, but that's a widely filed thing by energy traders, and it has been for a long period of time. It's just not an extra box we put up on our screen just to have something to talk about.
So that's it.
Our,
I mean, light news day, and I think it'll be a lot of regular trading, if you will.
yeah, let's pull over crude oil chart. A daily crude oil chart right now. Again, this rally continues. I'll go ahead and adjust my charts time. What are you seeing here?
I mean, yeah, rally does continue, but this rally might have stalled, right? Buyers can't push that up much higher, even higher than yesterday's high. You've got a doji at the top here.
Yeah.
It's small wicks, not a big trading range. So just maybe no news. Maybe um, they're waiting for news for tonight or tomorrow, but absent any news, this is looking like kind of a stall to that uptrend. But we also would need to know what happens tomorrow, right? This could be a reversal pattern or just a pause. We've seen pauses like this in the past. If you go back to end of February, you see a couple of dojis and then continuation of the trend. So I'm not saying that this is a top. I wouldn't say that at all until I see some evidence tomorrow of retracement.
Yeah, but you got this guy over here, right?
Right.
Right. So I hear you. So we're in wait and see mode right now. We don't
Yeah.
know really what this candle's telling us, other than it's price happiness right now, right? It's doji, open price, close price is the same. No trend has been that downward trend that we saw earlier today didn't continue, right? Buyers
Right.
pushed us back up. 82.24, the sweet spot here, and we'll see how it goes. But overall, the trend looks pretty positive, I think.
Yeah.
All right. Well, that's crude oil, folks, for you. Let's shoot over to gold. Well, you know what? I want to shoot over to Bitcoin. Tom, Bitcoin. I have gold and Bitcoin on my mind right now, but this has been extraordinary right here.
Yeah.
Big sell off. I mean, we had the strong rally. From a percentage point of view, Tom, 74,000 down to 63,000. That's more than 10% by a lot.
Right. That's probably about 15%. And you're breaking below your 20-day moving average, right? So, that's you're supporting rectangle. We could probably get rid of that. Um, this is what I would call a decisive breakdown of that, because not only do we break through that, we're trading below the 20-day. Now that could change, of course. We could it could just be a wick through if this market rallies. But, now we're looking at that 65,000 number that Mike pointed out was a good support level. Maybe that isn't, maybe we'll know more today. We'll see if it falls through there, but looking certainly bearish. I'm not looking to buy here yet. I need some more evidence of support.
Yeah, and we have that 37.5% retracement here. I just highlighted with an arrow. Peter, I hate to bring up Peter Schiff again, but he brought up that there wasn't a lot of net outflows in the ETFs, in the Bitcoin ETFs. Now, this has to be fact checked, of course, but if that's the case, this is truly a retracement, a sell off.
Yeah.
So that's a story of Bitcoin. Let's go to gold. Gold's looking pretty similar. Bear with me while I get a gold chart up. We have that wedge time you talked about yesterday.
Yeah, I mean this looks, we're trading within that wedge. It's so, it's such a a narrow area to trade, right? Yeah, we wick through the bottom of support again, but buyers are pushing this back up into that area above your rectangle. Very interesting. I mean, it's pretty precise, right? That we're right at where we were yesterday's open. Now we've retraced. It's kind of like a 2-day bar. If it were a 2-day bar, this would be a doji, right? Because we opened on Monday at this level. We're trading at that level now. Um, just waiting for, waiting for news, right? That's what this is.
Right. You shuffle these two together, and then the open and close price is exactly the same, or pretty close to exactly the same, that resulting in a doji, right? Price happiness right now. My guess is, again, this market is kind of waiting for tomorrow, just kind of like the stock index futures are waiting for tomorrow at 2 o'clock, and then again at 2:30 for the press conference, before before the river continues to flow through whatever path it decides to take.
Yeah, and you think of it like this. If you were to say you're trading gold and you said, you know what, I'm bullish or I'm bearish and I'm going to make my trades accordingly. Well, you're doing it right in front of a big number that could go, or not a big number, I shouldn't say that, a big announcement, but more importantly, a big press conference. And whatever's said at that press conference could go against your position, right? It could go against your ideas. And nobody wants to do that right now because they know it's going to happen. Now, there are traders trading it, and they might be trying to scalp, or they might be trying to, there are traders who might be filling orders for clients, and that's a different thing. But I don't think as a day trader or as a speculator, knowing that there's going to be a policy decision tomorrow and then comments about the future, which is what the futures market is all about. It's in the name, right? We are trying to take a position based on what we think of, which is of what's going to happen. And the Fed's going to tip their hat tomorrow at 2:30. So why would I trade now generally?
Yeah, no, I hear you. I hear you for sure. It's sentiment, right? It's trader sentiment coupled with technical analysis, and there is a fundamental basis right here, right? So you have the cash price, you have the futures price, and then you have the basis, the difference between the two, based on interest rates, based on cost of money. And this is the April 2024 contract, and it's priced in US dollars, right? You can trade gold priced in Japanese yen, or gold priced in euro, if depending on where you are in the world. But this one is priced in US dollars. So that's why it's going to be super sensitive, I think, for tomorrow.
Yep.
The other thing we didn't talk about, Tom, is Canada, by the way, because Canada, that's a good currency pair. I'll try to pull that up on the chart right now. Just came out with their CPI numbers this morning, and just read them to you. Year over year, actual was 2.8, forecast 3.1, previous 2.9. So that was a beat, right, on the year over year number. On the month over month, CPI came in at 0.3, forecast 0.6, previous 0. So a little bit worse than previous, but way better than forecast. And let's take a look at what happened in the chart here.
Yeah, it's kind of mystifying. Maybe this isn't necessarily entirely about their decision, because the forecast was up, right? It was forecast to increase, and it decreased. And not only did it decrease lower. It's inflation's lower than it was the month before. So you think, wow, that's good. Although now we've got this down market, maybe there is just such anticipation. The dollar is the key market with all three of those currency pairs we looked at, right? Dollar yen, dollar Aussie dollar, and then we've got the dollar Canadian dollar. And all, that's the common denominator. Is this means weakness in the Canadian dollar versus the US dollar, or strength in the US dollar. So, maybe there's some anticipation going on because of that.
Yeah, I'm going to ask Blue. I mean, maybe it's the FOM. Maybe the FOMC is just dominant, right? It's so dominant that everybody else is like, well, it's not good enough. We got to see what the FOMC does. we got a minute left, Tom. Let's take a look at the Russell 2000 here. Just the kind of, this is probably the big loser so far today. Russell's down 12.7. I don't have percentages up, but you probably do. We broke through this area of support and the 20 simple pretty readily.
Yeah, this is a follow through on yesterday's close below the 20, and now we're heading towards that 50 in green, your 50% retracement, harmonic retracement. You know, interesting, if you look left on your 50% retracement, that corresponds with the resistance area back in January. So go left almost all the way. And you see that area. Well, no, you did go a little bit to the right.
Okay.
Yep. Yep.
How am I doing?
Yeah, we're good. I think we can pick it up in a minute, but yeah, I think that 50% could be a support area.
Sounds good. All right, so we're gonna do a deeper dive in a second. Let's go ahead and take a really quick break.
So, you want to be a trader? Well, you should know you're not alone. Over the past several years, record numbers of people have set up their very own online trading accounts. There's never been an easier time or more inexpensive way for do-it-yourselfers to get started trading the financial markets.
Better futures start now with the Ninjatrader mobile app. With the power to customize how you trade on the go, you can quickly and easily place trades with a single swipe and view index, financial, energy, metal, crypto, and more futures markets, and access over 40 built-in indicators plus custom indicators, all from your phone. Stay up to date at all times by enabling notifications. Get started today at ninjatrader.com.
All right, we are back. Tom, finish your thought on the Russell right here. I mean, I kind of cut you off right here, going backward on my chart.
Yeah, so if you move your crosshairs to that 50% retracement level,
Yeah,
you go to the left,
yeah.
right there.
Aha.
Resistance becomes support. And I think you've been a fan of that as well, right? You can look to the past to see where might there have been some sticking points, some reversal points, some resistance areas, because those often become support areas. So, you know, it's again a kind of a prove it thing. But if you look at this, there is a trend channel that goes back to mid-January, right? You can kind of see like an uptrend there, paralleled by the tops, the highs at the top. You
Are
can
you
just
talking about, Tom? Is this what you're talking about or no?
go a little bit higher on that slope. Yeah, I mean, yeah, exactly. You can see where like kind of I'd go a little lower. Yeah, but that's okay. I don't think we've broken out of the trend channel. Yeah, there you go, something like that. And then, you know, that's another area that kind of converges with that area from January. We'll see. You know, that trend line adds a sense of time. Your resistance area from January doesn't have a sense of time to it, right? It's just a level. But when you add a trend line, that adds time to it, right? So if we look at it for support, you know, that support level will be hit. You know, if it gets hit and we stay on it, it has to hit a certain time at that certain level, if that makes sense. It's more of an XY thing rather than just a Y price.
That makes total sense. If we do it quickly, though, we hit that 50% fib harmonic. We hit the bottom of my rectangle, which was now support, and we hit the trend line all at the same time.
Right, right.
Hey, Tom, guess who the first to chime in is?
I know. I don't have to guess. I know it's Paulie H. Paulie, thanks again for being first one in the chat. You get a special shout out. And everybody, good news. We have chat in two places now, Jim. We have chat in our usual place, ninjatrader.com/events. We also have it at our YouTube channel. So if you're watching on YouTube, you can now rejoin the chat. Happy to have your questions, comments, trade ideas, just what's on your mind. Let us know. Let the community know. If you send us, if you put in a question in the chat, we don't get to it, maybe because people in the other people in the chat have. So appreciate your comments and questions.
Yeah, and I've been waiting forever to say this, Tom. If you you don't know what I'm going to say. You're like, oh no, what's he going to say? If you are on the YouTube, on the YouTube stream, smash that like button for us. That'd be awesome. I just had to say that, man. Sorry.
Hey, you know what? I'm making smash burgers tonight.
Oh, there you go. See,
Yep.
Perfect. There's nothing
Very
better
good.
than smash. Do you use mushrooms?
I've never made them. This is the first time.
Okay. All right.
So
I don't
we'll
want
see.
to push the mushroom thing. I read somewhere where if I eat enough mushrooms, like a couple tons a week, I'll live for 200 years. And then I thought, I don't know if I want to live for 200 years. But anyway,
Right.
There we go. So I pulled the Russell up here, Tom, the opening range, which starts at 930 to 940. So it just kicked off right now. I just stayed with the Russell just because that's the last thing we talked about. And we have some buyers coming in right now, approaching the volume weighted average price. After this little bit of a sell-off here, and we're right at S1 with a nice volume node, a little bit south of where we're at, 2036.
Yeah, and notice how during the evening, price traded around that VWAP pretty well. Europe comes in now. VWAP starts acting like resistance, and so I'm going to keep that in the back of my mind. But here's the thing: now it's U.S. Trading has begun regular trading hours, and you can see right now it's just pushing it right back up VWAP. So interesting that the market is kind of rejecting the prices down below. At the lows, a little bit of consolidation for the open, and now volume coming in to push this market up, and even your MACD is kind of trending up. It's been trending up, but it's now crossed over its zero line on the histogram, which certainly is a bullish move. But that could be a change in momentum. It could continue. So we'll see.
Yeah, I'm gonna draw a trend line on the actual MACD, loosely fitting. You could do it. This is in panel 2 of my NinjaTrader chart. It's easy just to draw those trend lines on a panel, no matter what's in it, and then the same thing with the chart itself. So yeah, that trend is nice. This is looking pretty strong right now. We'll see how it goes. Although a target wick just was generated up to the top of the value area, right? The transition between value and prices above value as they define it. What do you make of the VWAP bands, Tom, arcing down?
Well, I think it's just a natural calculation of where we started. We were started below the VWAP, and then volume comes in. It's going to pull it down, right? It has to trade above VWAP to start pulling it back up. So, that makes the VWAP easier to cross. But if that VWAP holds as resistance, then it doesn't look good for the Russell, right? I mean, it's pulling the VWAP down because all the trading is below VWAP, and that just makes this market a little bit more bearish if it can't get above it, which, it's struggling right now, but we've got, 20 plus minutes before the 30-minute opening range is done.
Yeah, I know. Got a long way to go. Long way to go. Let's kind of pull over to the E-mini S&P. And Tom, who's here with us today?
Got a great group. Anissa, good evening. Welcome back. Zane G, Theo G, Build Back Better is here. Newport, Jen P, Raleigh, W. Ray, Herbert on the range. Mom and Dad Cags, good morning. Stephen Rios, Lewis H, Just Learning, Foggy Cape, Andrew Morris is here. Nola Boy, Robert W, Jock, Boston J, Turtle, Ames, Robin is here. At Home ATM, Tony Lyons and Mac Rangers are back. LB Sam, that might be a new name. Ripper 24, Carlos M, Avi, Tamtin P, a new name. Matthias, I'm going to butcher this. Matthias R. Sorry if I mispronounce your name. That's who's here with us so far at the opening range.
And Tom, that's why I asked you to do this. I can't pronounce anyone's name right, so you did a good job. You did a darn good job. And also, let's remind everybody who just came in today. Historic day here. We have quite a lineup, right, going forward, Tom?
Oh, right. Yeah, I can't wait. So at the 10 o'clock hour, we're going to be joined by Dan Gramza, and Dan's going to be helping us look for trade setups. We're going to look at the charts through Dan's eyes. Dan, if you haven't seen him yet, I'd suggest when we're done at noon today, you go over to YouTube, you go over to our Learn page, and you look up Dan on the See the Futures channel. He's just a great, great analyst. And I know Jim, great friend. You've known him a long time, as has Mike Burke. And then at 10:30, we've got another great guest, Blu Putnam. So Blu Putnam recently changed his role to retired, semi-retired. Who knows? But he was the chief economist at the CME. I mean, it doesn't get much better than that. That's pretty amazing.
Tom, I'm pretty sure he said, I was out and they sucked me back in.
Well, you never really retire. I mean, somebody who was the chief economist of the CME, we have friends who, they don't stop, right? You just can't stop. So that's great. And then I will be here and that will be Jim and Blu at 10:30, and then I will be hosting another legend, Larry Williams, legendary trader, author of many books, over 10 books. And just an amazing gentleman, really, really interesting way of explaining his look at the markets. I could sit there, pass the popcorn kind of thing. That's at 11 on Traders Workshop. So boom, boom, boom. You don't want to leave.
Yeah, I remember the first time I heard Larry speak live, I was like, what's all the buzz about? It was at a conference or an expo or somewhere way, way, way back in the day when probably before half our viewers were born. But so I elbowed my way. It's a jam-packed room. I elbowed my way in, right? It might have been in Las Vegas. I don't remember. And standing room only kind of thing, and mesmerizing with his knowledge and his information and his perspective on how price moves. So I can't wait for Larry.
Yeah. And remember, people like Larry, Dan, Blu, they were doing this analysis, way before not way before, but before the computers really took off, right? Before you had a Ninjatrader to look at the charts, right? Yeah. I won't talk about I mean, Larry will tell you what kind of tools he used back when he started, which is the advancements are amazing. So it's pretty cool that they were able to do all the analysis they did. And that's probably why they're the experts, right? They're the ones that did it.
Absolutely. Looking forward to it. It's going to be a great day. Let's check out this 10-minute E-mini S&P chart right now. And interesting we have a drive on the opening range. We had a drive above, low volume still, 285,000, a drive above the volume weighted average price. And then we hit that 62.5 harmonic, right? Remember this, I measured high to low trend. The dominant trend is down. And so we hit this 62.5% harmonic, which was Mike Arnold's level of choice. And sure enough, we bounced right off it and back down. And now we're below VWAP here. This is why I love to look at this fib line. And I love to see either closes above the 62 or 62 rejecting price, which is what it just did.
Right. And if you're looking at the Fibonacci retracement tool, this is what Jim is using. He's just altered his Fibonacci retracement tool to change the values that are close to the Fibonacci values, not exact, but the harmonic nature of the motion of things, right? That's what this is trying to reflect in the markets, right? The wave-like nature of the markets. Dividing up that trend into harmonic values is what Jim's done, but all he did was alter his Fibonacci retracement tool. So you won't find a harmonic retracement tool. You'll just have to alter your Fibonacci retracement tool to reflect those values.
Yeah, and it's interesting in either case, right? If you use traditional fib levels, right, it's based on a nature, If you use harmonics, it's based on nature. You know what I mean? Both of these techniques aren't some kind of random technical analysis generated numbers, right? We see them all around us in the world.
Right. Right.
Anyway, bottom of the valley area right now. Again, we're going to kind of wait to see what happens in the opening range here before we leap into action. But this is a dominant candle so far. It's pretty big. We got about 34 seconds left. Let's stay tuned right here for this candle to expire. We have about 34 seconds left. And look at this volume deficit right at prices below value. Look at where the shelf is. This is a volume shelf. I'm going to go ahead and do the same thing I did yesterday because that actually held all day until like the last 5 minutes. Remember the last 5 minutes yesterday?
Right.
This held. This volume shelf here is telling us there's less transactions that have been done here. Just look at how long they are versus what's happened in the actual value area. And so I'm going to draw that right now, and that's part of my area support until it's not.
So Jim, would you think that possibly that area might get filled in? Because I always think of the distribution also as like a bell-shaped curve. So in order for this to look more like a bell-shaped curve, you might see some trend down into this area to fill out that little gap, because we do have a competing point of control, right? If you were to isolate this range that you've highlighted, there is a point of control for that area. And so it might try to fill that in. But really, anybody's guess, right? Because the market doesn't always, as a whole, doesn't always look at these gaps.
Yeah, no, that's right. That's right. For sure. So just kind of using my crosshairs here, what Tom has said so nicely is this should be more of a rounded type of distribution if it was a normal day, right? A normal volume distribution where you'd have a standard deviation measure, you have a median, a mode, you have a smooth type of bell-shaped curve. And now we don't. We have this area right here, but believe that potentially could filled in, right? In a normal day, this would be filled in a little bit lower than where we're trading right now. Now, yesterday, we didn't see that though, Tom. We saw this was a hard stop yesterday when we saw almost the same pattern. It was more of a P-shaped, capital P as in Paul, shaped distribution yesterday, but we did see it, and it was pretty fierce.
That's right. That's right. We have some other shout outs. Blue Hawaii is here. Beach Bum, I like that name. Eagle, Ramton P, and Newbie S is back. So thanks for joining the chat. By the way, Jim, maybe we could walk through that Fibonacci retracement tool. Ripper24 is asking, is it an add-on for your harmonics? And I think maybe if we could just quickly walk through how you edit your Fibonacci to reflect the harmonics.
Yeah, so it's easy to do. So the first step is you apply your standard fib on your chart, and then you can double click on it. When you double click on it, it's going to open up this dialog box, right? You're going to have a whole bunch of stuff on the left-hand side. It's going to be highlighted what you double clicked on. And so when you do that, you're going to see this properties window right here on the right-hand side with a bunch of data in it. If you go to levels, now this is a little not quite intuitive, but it's pretty easy. You go to levels and you click on that, edit prices. Then you could change your configured fib numbers, right? 38.1 becomes 37.5, and just go up I don't have a 12.5 on here, but I do have it. It's down here, but it's 12.5, 25, 37.5, right? So it goes in 1250 increments all the way to 100, and you get these 8 increments here. So once you do that, once you change this to whatever numbers you want it to be instead of the default Ripper, then you hit OK, and you've changed it. Now you're not done yet. There's a template down here at the bottom. You can click on that, and if you want to say save, you could click on the save, and then you have a couple choices. You could name it something special, or you could save it as your default. If you save it as a default, every time you draw it on your chart, it's going to show up that way. So I have it as my default right now. This is relatively new to me. This is like, I don't know, a month. When was Mike Arnold on before? 4 or 5, 6 weeks ago. So I saved it as default though, just to make it easier for me. Otherwise, you could just toggle between these. Hopefully that helps. That's how you do it. It's pretty easy. So no special plugin, no special anything. All right, now we're starting to fill that part of the, prices below value, just like you suggested, Tom. We're starting to fill in the volume there. You can see those histogram bars moving right now. We still have another 5 minutes and 50. Oh, we're not even to the 15-minute mark, are we?
No.
We have, yeah, I didn't have my glasses on today.
Let's go to the Dow.
Yeah.
Can we go to the Dow? Because we'll come back to this when we're looking for trade ideas, I think.
All right, let's do the Dow. Dow is a little bit perky so far.
Yeah, so interesting about the Dow, I think, is it's got more of that bell-shaped curve. It's not perfect. You've got three areas, right? You've got three areas of volume distribution. The middle, the value areas, where it was trading for pretty much the start of the session to overnight to Europe Open to Europe kind of midday, little bit of a down tick when their mid morning, I should say late morning, bringing it into but it did hold till about 7 o'clock in the morning, where it might be pre-market for some of the US. You might call that pre-market. Started making another volume area, which is out of value area, right? Out of the value area. And then now with the opening range, it had a rally. Opening range pushes it above the volume distribution, and now it's making a new distribution up top out of value area. So it's a really interesting pattern, right? And the volume just isn't there at the open to make this a competing point of control yet. But it is positive, right? The Dow is getting a lot of love today from the buyers. I don't know.
Yeah.
It's just a tale of two different stock index futures, right? Russell to the Dow. A lot of times they're doing the same thing, just not in the same magnitude. But here, a little bit of the divergence with the Dow being up today and the Russell being down today.
Well, maybe Boeing's figured out how to keep their doors on their plane. I don't know.
Are you flying anytime soon, Jim?
Yeah.
Are you checking? There's an app you can check what maker of plane that you're flying, or choose not to fly if that's the case.
Really?
Yeah.
Yeah. All right. Well, that sounds a little complicated and ambitious, but I'm going by price, and I'm just gonna hope the doors stay on. That's all. Going by price. Oh my goodness. See, we're getting advanced here. All right. So the rally continues though, Tom. This is kind of an interesting thing. We've lost VWAP in the rear view mirror. The R1 now is in play, right? Yesterday's highs are marked up here at 39,336. We'll see if we get we don't have an area, as far as I'm concerned, we don't have a measured area of resistance yet, right? We have a series of higher highs. We can count them. I mean, it started down here. It started down here at 820 bar. 1, 2, 3, 4, 5, 6, 7, 8 higher highs in a row. That's pretty positive. And I think it's reflected down here in the RSI also, or the MACD, sorry.
The MACD. So interesting about the MACD is you got that crossover on the two lines, right? The MACD and its signal line occurring kind of in a consolidative mode, right? So if we look at what happened before that cross, market was kind of going sideways, right? I mean, it's probably 7 or 8 bars. That's over an hour. It was sideways, but then that MACD pops even before, I think, that big bullish candle. So, if you're looking at MACD for signals, that's the signal that people look at, right? Which is the MACD. Yeah, maybe it is. Maybe it was with that pop.
It's kind of like in the middle.
Yeah.
So it's a difference between these two histogram bars changed from negative to positive between these two with these two bars. Yeah, but still the trend was going toward that cross, right? So it was subtly, slowly going toward that cross. So I think you're onto something.
Right. So in a very aggressive way to use MACD is if before that cross, you saw that histogram was turning up. So if you go about 5 or 6 bars to the left, maybe more right there, you see how that histogram was getting more negative, then it turned around and was getting less negative. Some people will trade that, which I think is really, really aggressive. And of course, you could be whipsawed as you see what happened before. There was an occurrence of that before, and it didn't last long. That uptrend didn't last long. It turned right around.
Yeah.
But that's a very aggressive interpretation. You're trying to get the low, which we don't recommend, right? It's very dangerous. But the kind of not even conservative, it's kind of middle of the road, is using that MACD crossing its signal line. You're not going to get the low, but that would have been a nice trade. Not always going to happen.
Performance.
Yeah.
Past performance, not indicative of future results. We got to say that.
Right.
Because a lot of times these observations, they're, you get this textbook kind of, well, it's a cross up, so we're going to get long. It's a cross under, so we're going to get short. That's kind of a textbook theory or an idea that really needs to be used in combination of the other technical analysis you're doing, because that among just by itself doesn't always work.
Right. It could be something about volatility. You want to see it, are we in a tight volatility range? Are we, big vol, small vol, volume comes into play. There's all sorts of things you can look at it with.
For sure. Anyway, so that bar just completed right at the end of your sentence, Tom. And a little bit of it's almost the body of the candle was pretty similar. Let's just kind of zoom in a little bit. Even though we have a wick at the top here, a shadow at the top, the body of the candle, I guess technically it's an inside bar, but it's pretty close to the size of the previous candle.
Yeah, and that inside bar is technically, yes, it didn't get quite as high as the open. It didn't get quite as low as the close of the previous bar, or I should say that the other way, right? It didn't get high as the close of the previous bar. It didn't get as low as the open when we're comparing opens and closes.
Yeah.
Not, okay, so now it's turning back around. A lot of times you see these big moves. If the consensus is we're turning around, then a lot of those long positions start selling and force that market down.
Yeah, and I just drew a fib line here. The point of control is right by the pivot. I was hoping it would be right at the 50%. It's not. It's between 50 and 37. But there's a whole bunch of, there's some areas of interest right here, right? We have the yesterday's close or today's open, same price pretty much, just glancing to the left side of the chart. VWAP, pivot, everything is right here now. So this is an important area of interest right now as we're driving back down here. I wouldn't be surprised if we saw that 39,217 again in sometime this morning.
Yeah, exactly.
All right. Well, again, let's let this opening range we got 8 minutes left. Let's go over to crude oil. Let's go we're in the May contract, folks, everybody. April is gone. Forget about April. April was interesting month. Let me let my charts get some data in them here before I start moving them around. Let's go ahead and open this up. And we see that the distribution is a little bit lower. Volume distribution is a little bit to the south side. So envision a small case B as in boy distribution. Point of control is 8203, competing point of control 8216. And this is looking just like the last chart, Tom. This is looking like the Dow.
Yeah, and I'm sure that there's probably not a lot of correlation, but I think a lot of markets today will be consolidating, right, overnight. Maybe not the currencies, right, because we talked about the central bank of those countries, but yeah, consolidation, and then just waiting at least to see what the the institutions, hedge funds, et cetera, are thinking about the markets. What are they thinking, right? Are we too low? Are we too high? Or is there accumulation here that's going on? And then just moved with the big volume. But crude pulling back a little bit. And we see on the daily chart, we were kind of at a doji, right? We were kind of not really doing much. Now it's probably more of a green candle, which if we were to close at that point, suggests maybe the bullish trend is still in play on a daily, but we've got a ways to go to see where that happens. If we see a pullback and even a close down, that changes the scheme of things, right? What it does for the bull trend on the daily.
Yeah, pretty interesting for sure. So anyway, we'll keep an eye on it. We'll, again, this VWAP though is pretty far away. So when I'm thinking, dominant trend is up right now, right? And you could measure that a couple of different ways. I mean, you could there's a lot of noise, right? A lot of a big frequency up and down pre-market. So you could make an argument that the dominant trend really started approximately here. What time is that? 8:30ish, and then continued up until a couple candles ago. And now it's like, all right, where's this retracement? Where's that 62.5? Well, the 62.5 is in the value area. It's a long way away. And the VWAP's even further away, right? So the idea that we've been tracking the last couple of shows, Tom, where we want to wait for retracement and then go with the trend again, in this particular chart, it's not there for me.
What about going against the trend, right? It looks like kind of a smallish day. We might be capping, we might be topping. What if we took a breakout trade of let's say trying to get back to that 62.5%, make it a shorter trade? What do you think?
So that's a good idea. I just really quickly, let's look at the daily just to see what that is. Now we're going against the long-term trend too. So just keep that in mind. So this makes this even more risky, but again, if everything's going to settle where it's going to settle ahead of FOMC, then maybe you're right. Maybe this trend is going to stall until FOMC does its thing. So a breakout trade would be entering on a stop, right? So we'd enter on a stop market order somewhere, right? 37.5 or even below the opening range. What do you think? Well, we should probably get it in there now if we're going to do it.
Yeah, we're kind of going out of turn, but we're seeing an opportunity right now. So we're going to jump on it. I think you have a sell here and try to get back to that, into the value area, maybe to the 62.5% retracement area.
Sounds good. I'm just pulling up a trading ladder here. All right, so here's the trading ladder, folks. Remember, everything is fungible here. So you place your trade here, it shows up there, vice versa on the charts. So we got to put some stops in and some targets in time. I'm sorry, where do you want to go with the target first?
Let's go about 82. Let's go 82.20. I think right below the, yeah, let's try that. I think it's right below the 62.5 percent. It's kind of an even number. You've got those resistance areas on the left. It tried to get above, tried to get above, tried to get above. So maybe it's going to be a support area. And like I said, this is going against the grain. Like, Jim said as well, it's kind of going against the daily trend. So we don't want to make it too big of a target.
Yeah, no, I know, but okay. So I'm thinking, I like your thought process. I do also like this VWAP. I mean, we've been trading through it with the exception of the last hour or so all the time. So I can envision a case where we wick through that VWAP, right? We wick through it. And that gives us a lot more meat on the bone. Alternatively, this is kind of a conservative place, but we also have to keep in mind, we have to put a stop in too. So that's going to be another struggle that we're going to have here, but we could do it. We have the harmonics. We have another harmonic here. We don't want the risk reward ratio to be too out of whack. So that's for sure. But I rely probably more on these harmonics, or at least the piercing line of this candle, but it's not closed yet. So you don't know where that's going to be.
Right. I'm leaving it to you. I think,
I'm going to estimate it. I'm going to estimate that piercing line here approximately there. And if you go all the way to the left-hand side, there's a little bit of a volume deficit where my crosshair, it's subtle, it's small, it's not that big of a deal, but this trade then will become a little bit proportionate. And remember, this is a $10 tick. This is a bigger size contract. So keep that in mind as well.
Right. And Jim, I think your idea about wicking through the VWAP is valid. I wouldn't be upset if you changed it. It's your trading account, Jim. It is a simulated trading account, but it is your trading account. So far be it from me.
Yeah. Hey, Tom, why don't you just sell 5 in your account? That's pretty good. Yeah. So, I mean, we don't have that much time together here with everybody. So let's, actually, we do have a lot of time. I forgot. We're going 3 hours straight, folks. We're on a roll for sure. We will get to Bitcoin too. So here's the other thing you could consider, right? You could consider trailing your stop, right? And it's easy to do. You just click and click on the trading ladder to a different price, cancel and replace. You could move your stop to break even, which is probably what I would do right now because we're kind of in a tight range right now. But that's going to increase my ability to get stopped out if I do that, right? So maybe just tick and tick. As long as we're below this 82.33, I feel pretty comfortable. What Tom suggested before is, hey, maybe wicking through a VWAP is a good idea. If that's the case, then you probably want to move your stop back up to where it was.
And to point that out, Jim, on the trading ladder, you have VWAP marked. You can mark the trading ladder with different studies.
And it's funny, Tom. It looks a lot closer on the ladder than it does
on the chart.
On the chart, doesn't it? I mean, the chart looks like it's forever away, and it's the same numbers, right?
It's like
so. Anyway, yeah,
glass half full, glass half empty kind of thing, right?
Yeah. So again, I think if we move our stop to break even, we're exhibiting a lack of patience, and we're not letting the trade mature. So it's literally 1, 2, 3, 4, 5, 6, 7 ticks away. That's about a $70 gross P&L risk on this, and then the downside, it's about 13, so $130. So I think we're good from that point of view. Risk reward ratio. We'll hang tight and see how it goes.
Awesome. I think let's take a quick break, and we will be back with our very special first guest of the day.
Awesome.
So, you want to be a trader? Well, you should know you're not alone. Over the past several years, record numbers of people have set up their very own online trading accounts. There's never been an easier time or more inexpensive way for do-it-yourselfers to get started trading the financial markets.
Better futures start now with the Ninjatrader mobile app. With the power to customize how you trade on the go, you can quickly and easily place trades with a single swipe and view index, financial, energy, metal, crypto, and more futures markets, and access over 40 built-in indicators plus custom indicators, all from your phone. Stay up to date at all times by enabling notifications. Get started today at ninjatrader.com.
All right, let's talk futures coming on live right now. Dan Gramza, Gramza Capital Management. Dan, good morning.
Good morning, Jim.
How are you?
I'm well, thanks. Good to be with you.
It's good you're here. This is like the best day of my life. We have you, we have Blu Putnam, and we have Larry Williams all in a row on the show today.
It's going to be a busy day.
I know. I had to stay up extra late last night doing homework just to keep up with you guys. You sent me the charts you wanted to look at. Blu sent me a bunch of information on employment, and Tom. Fortunately, Tom gets to do the homework for Larry. So,
got it. Well, we can go through these however you want, Jim. I'm very flexible in that way, as you and I have had in the past. So,
yeah, for sure.
Lead the way.
Sure. Let's start with a daily E-mini S&P chart right now. Hopefully you can see this. It's not too cluttered. I have a volume profile signature here over the last 7 days, trying to capture this new level, this new consolidation level we're at. And one thing I noticed, Dan, is it seems like we've been rallying, pausing, and I highlighted those with trend channels, right? Rally, pause, sideways, I guess I would call it. Rally, sideways, rally, sideways, rally. Now maybe we're sideways again. That seems to be the trend the last few months.
You're right on target, and that's a natural rhythm, especially in financial markets. The idea is that you go from imbalance to balance, imbalance to balance. The imbalance is that sprint, the balance is the market catching its breath. And that's the rhythm that you're seeing here. So currencies, you'll see that as well. Interest rates, you'll see that. Commodity markets vary a little bit in that regard, but the same principles are there. That's a great observation that you made. And the things that we could now look at is we could say, all right, how big of a rally does it take before the market catches its breath? And then when it does, how long? How long does it take? And it could be because of fundamentals. So you'll
Right.
see.
So,
Go ahead.
Dan, I just, I don't want to get too far behind on my questions, but so sorry to interrupt.
No
but
problem.
When you talk about imbalances, right, the race, you call it a sprint or a race, which is great. What causes that?
Oh,
Yeah.
it's typically, especially this market, it's the anticipation of something coming. Now we got that coming tomorrow with the Fed. It could be an announcement, an actual fundamental announcement that comes out, and it causes that expectation. So the market absorbs it. One of the ways you can think about that, and that's a great point that you're raising, is when you see that large move.
Oh, I'm
Whatever.
sorry. I just
That's
did
all right, no
something.
problem.
I
When you
just
see
did
it,
something. I'm going to go back. Hang on.
sure. But
Bear
when you
with me.
see a large green candle, for example, which we'll see here in a minute.
Yeah. I'm back. Back on my feet.
Okay. So if you look at that, one of the ways you can think about it, let's say that day right there, that large green candle. I don't remember the fundamentals on that day, but if an announcement came out and the market said, yes, that day, ooh, this is really a good thing. What it's saying to us is that fundamental that drove that market expectation was worth that amount in the S&P. So that fundamental equals X number of points in the S&P. So I look at it from the way of how does the market digest that information? What does it mean to that market? And typically, once it's digested it on that day, you don't see another day like that afterwards. I mean, if you look at this chart, how many large candles do you see one after another? Actually, you don't see too many at all, right?
No.
And but that's normal. That's typical behavior. And so I think the market here, as we're looking at that, is very orderly. It's the imbalance to balance kind of movement. And what I mean by imbalance, it's where you see a drive in the market. So it could be sellers coming in and hitting it, or it could be buyers coming in and driving prices higher. So not unusual behavior. And right now, Jim, we're so orderly in terms of market expectation. That volume profile you have next to it is a good example of a market evening up. It's getting ready. It's waiting for information. It needs an excuse. Markets need an excuse to do something. And that's one of the things fundamentals can give us. They can give us that excuse. And it could be anticipation. And that's what we've seen in the stock market. They're anticipating what they want the Fed to do, what they think the Fed should do. That's part of what we're seeing here. It could be a situation where we don't have enough of something in a commodity market. That's a different driver, but you'll see this kind of rhythm with that kind of market as well. So right now, if you look at those high volume levels that you have, look how we've contained this market inside those ranges. Yeah. So it's orderly is the way I look at it. Today, and actually what it reminds me of when I see this, a couple things. One, if I think about some of the banks I deal with, like in Europe or Australia, they when you have an announcement coming out like the Fed, they even their position up. So the risk manager on the trading desk may say they want to go neutral. So you'll see buying and selling, which is what I think these candles represent to us. And as we go into that announcement, you'll see overnight, you'll see them even up. They go to a very neutral stance. So if you watch Europe tomorrow before our announcements here, that's what you expect to see. Institutions, they usually don't take a position going into something. They will, although we saw that with the yen to an extent. But the other thing
Dan, the bigger players, the institutions, are taking a position. Hey, we can still trade right now, but we want to kind of be neutral. But when Chair Powell gets up on that podium, we want to be neutral going into that. We don't want to be too heavily weighted one way or the other because we don't know what's going to happen.
That's right. On a currency desk, FX desk, the risk manager may say, we want to maintain a $100 million book position in the euro. All right. And they call it a book. And depending on the institution and how it's structured for their trading, they pass that position around the clock. So it may start in London, and then they pass it to United States, and we pass it to Asia. But they trade, like you said, Jim, they trade around that position. They may be 150 million long or 150 million short, but at the end of that trading time period for that time zone, they're back to 100 million. And they'll maintain that position. Now, before a number, they may lighten that load or increase it. Typically, they lighten a little bit. They may take it off. That goes back to what the risk manager typically wants to do, maintaining or not maintaining a position going into an announcement. The other thing that's dominant in the market we are looking at is that was all inside that big green candle that we had here. Actually, if you
hang on, I'll go back to all right. So I want to go to the Aussie dollar because they had had an announcement this morning, and because you were talking about currencies. But let's go back to the E-mini S&P, and I do have another observation on this chart I'm going to ask you about in a second.
Okay, that large green candle you see a few days ago. Notice all the action afterwards. It really hasn't blasted above or below that range. I call that a benchmark candle. And to me, as I look at this, I would say this is a market that has a bullish bias and a neutral position at this point. It's a market on the sidelines waiting for information. Very calm, actually, when you look at that, those high volume levels and how it's traded. Yeah, let's take a look at the Aussie.
But hang on. So I wanted you to comment on this. I mean, I learned a lot from you over the years on candlesticks. And oopsie, sorry about that. Let me just circle these two candles.
Okay.
Now, what's going on here? How would you characterize these two candles?
I call that, in this, what I call my behavioral Japanese candle approach. I call that an equal and opposite. In other words, it represents rejection. And here's a way to think about it. If we would add those two candles together, Jim, so we go from the opening on the first to the close on the second, that means we have the top of the red candle to the top of that green candle. That's the open, right? And that, if we add those two together, what we have is a very large shadow or wick on the bottom. So it tells us that the market, exactly right there, Jim, you're on the money. As we broke lower, as fast as we went down, we came right back up.
Oops, I didn't mean to do that. Got it. Yeah, that makes sense. Okay, so there was something to cause sellers to say, aha. And then whatever that something was, the very next day was reversed.
Yes, and probably because that was something that the market was interpreting. It wasn't reality. It could have been somebody's making an announcement at some meeting, and they go, "Oh my gosh, they changed everything." They didn't change anything. The policy's still in place. It's a knee-jerk reaction. And so it's rejecting that lower price. And it's pretty violent when you see that kind of behavior. So
Well,
that's
yeah. I
why
mean,
I would look at it.
the open to close was 50 handles.
Yeah, it was a biggie.
Yeah.
Yeah, it was, yeah, a lot of volatility. But see, what's interesting about it, as fast as we went down, we came right back up. So what was out there? That's why I think it's important when you and I see or hear any kind of market news that we think about, what does it represent? Is it real? Has this happened? Or is this something that may happen?
So, in your experience, let's pretend we don't know what this candle is, right? Let's pretend this is today, right?
Okay.
We just closed. This is what we have. We have a pretty big shadow or wick at the
Mhm.
top of the candle,
Mhm.
right? Equal and opposite, tad bit of an inside bar, not really. But would you say, based on your experience, then you would expect this day to be an up day?
Well, the bias is for an update because you got that big rejection on the downside. But
Okay.
actually, I wouldn't expect that much volatility. It more common would be for it to open inside that upper shadow or wick and to trade sideways, catch
Up in
its
here.
breath again, imbalance to balance. And here it did give us some movement to the upside, and then we stayed. Then we did catch our breath,
Yeah.
right?
Yeah.
That's when we went sideways for a couple days.
Wow.
So,
That's awesome. All right. Thank you for that. I
sure.
caught that out of the corner of my eye. I said, this is something I want Dan to tell me about. Let's just shoot over to the Aussie, because I think the Aussie,
Okay.
I don't know, what are they called? The Royal Bank or the,
RBA, yeah, the Royal Bank of
Reserve Bank of
Australia.
Australia. Right.
Your
So
Reserve Bank, I mean.
they
Yeah.
came out with basically unchanged, right? On their cash
Yes.
rate. They call it the cash rate, 4.35%, which
Correct.
is maybe where we'll end up at the end of the year. Who knows? But so we had this big sell-off because of that.
Well, here's the thing about this that I find fascinating. Because if we think about our friends in Australia, I think we also have to think about our friends in Japan. And if you think about carry trades, where traders, in fact, there's some banks I deal with, and they have a trading desk, and this is all they do are carry trades. So if I could go to Japan and borrow yen at a very low rate, and then I go to Australia and I convert that yen to Aussie dollars, put it in the bank, and I got the difference in interest rates. So that's pretty good. I could pick up maybe 4%, and I don't have to do anything. I just got to hold this. And let's say I borrowed it for 90 days. Well, what are my risks? My risks are that when I go to convert my Aussie dollar back to Japanese yen, right, that rate of exchange has changed. So now this profit that I just gained, I could lose it when I go to back. But that's something, as you know, we could hedge against. We could use futures to hedge that so we don't have to worry about that. But we're seeing people getting out of the Aussie dollar today. That's what it's saying to us, because this is against the dollar, that we're US dollar,
Yep.
right? So people are exiting. And we're also seeing that in the yen, which is interesting. People are stepping away because the dollar, in times of uncertainty or in times of a potential major announcement, people will back away from other currencies and they go to the dollar. It's when you have, unfortunately, a serious situation in a country, like a terrorist attack or something got awful like that. Typically what happens, the US dollar gets stronger, other currencies get weaker because people pull, let's say I don't want to even say Australia, but let's say whatever that country is that had that incident, people have a tendency to pull away from it because there's uncertainty. And currency markets don't like uncertainty, and neither do stock markets. So they typically crash. It doesn't mean there's a change in trend. You know, Jim, when I said that, I'll tell you an example. And this, I can't remember the year, but I was.
That's okay, Dan. I sometimes can't remember what day of the week it is, so you're okay.
Me too. Me too. Anyway, it was a number of years ago, and I was doing some work with a very large company that invests in South America. The Mexican peso fell out of bed. It just dropped tremendously. That means all the currencies in Central and South America dumped, and they had nothing to do with the thing in Mexico. So Argentina, their peso really plummeted, and so did their stock market. What was interesting, now this company, they invest locally. So they buy that local stock in Buenos Aires on the Buenos Aires Stock Exchange. Here's the thing you want to think about. Did anything change for the companies in Argentina? No, nothing changed. They were still, if they were a good company before the peso fell out of bed, they're still a good company. They're just a lot cheaper. Nothing has happened fundamentally within that stock. The issue for them was, when do we buy it? So it was an example of them recognizing that drop in the market really had nothing to do with the stock market. And I think that's one of the things we want to be sensitive to when we think about currencies. And so right now, with the dollar getting stronger, you know, they're, again, not surprising to see that before these announcements.
Yeah, so a little bit of a domino effect, maybe.
It is. We are connected, you know, in this big web, or whatever you want to call it, globally, economically. It's fascinating. But look at the way we're coming down in the Aussie. Look at the way
Oh,
you came up. Oh, that's
sorry,
right. Leave it there.
I just switched to another market. We'll go back to the Aussie. Hang on.
Oh,
Oh, I wanted to talk about copper.
sure.
We have plenty of time though. Hang on.
Oh, okay.
Let's go back to the 6A. That's the ticker symbol. June 2024. Well, I'm sorry, I cut off your observation.
Oh, that's okay. You know what's interesting? Isn't it easy, Jim, like how you can change markets with that watch list you have there? It's a great feature.
Yeah, you could you could
can
link the chart with the trading ladder with the quote board market analyzer. Yeah, it's pretty slick.
It is. Well, anyways, the Aussie dollar, I just wanted to point out, we were talking before about imbalance, balance. Look at those two big green candles we had in the Aussie dollar.
Mm-hmm.
And then the candle on top, that's really that rejection, or like an equal and opposite. Yeah, that guy right there. You know, is what we looked at before, only it's on the top. That could be a green candle followed by a red candle. Only this happened in one period. So we saw, and when it hit the high, that was green. So what we saw is a change in characteristics. Two big green candles, it rallies to those highs, and boom, it finds sellers. Okay, now look at behavior afterwards. Is this market coming down the way it came up? That's right. Look at I mean, we've seen some volatility here, and we got some today, but look at the way those three candles, actually, if you include the one on top, because that was green for a while. If you think about how it went up compared to the way it came back, from my point of view, it's not symmetrical. Therefore, the bias is for a move to the upside. But so far, we haven't seen any consistency on the buying side. It'll be interesting to see how the Aussie dollar finishes today. Does that shadow that you have at the low, or that wick, does it get larger? In other words, do buyers now they're recovering from it, imbalance to balance? How do they want to go into tomorrow? So, but you want to take a look at copper? That's an interesting market too. Whoa,
Let's
daddy.
do it. Let's do it. Let me get my my crosshairs back here. Let's go to my metals section of my market analyzer. HG is the symbol, and it will populate here in a moment. And the data is coming in right now, Dan.
There we go.
Let's tighten it up a little bit. Now, I have some measured moves here that Tom Schneider was schooling me on with respect to, these are the black lines. Here's the measured move on the upside based on this low wick we had back here on February 9th. But right now, it seems like the trend's reversing.
Well, first, what Tom was thinking is very logical. And it's a way to think about the magnitude objective for a pattern. So that part I think makes sense. But what we see here right now, it's a market moving on anticipation. So what's happening with copper? Well, one, we need China to participate in a couple ways. One, demand. China soaks up about 50% of the global supply of copper. But when you and I think about China's economy, when we think about it has not recovered as people anticipated, that demand hasn't been there. So China, they recognize that too, and they say, doggone it, what can we do to stimulate things? Well, they can lower interest rates to make investments more attractive. They can pump in capital. They said they're going to put in $1 trillion this coming year. So the market goes, holy Toledo, that's fantastic. It starts to take off. And one other thing that China does is they smelt copper, about 47% of global supply. So they said, you know something, we have some smelting operations that really aren't that profitable. And we're going to cut back production on that. So the idea is that it makes an increase in demand. And that's what we're seeing here. You know, the issues here, I think, for copper, have they done that? Has that actually been felt in the market? Has the real estate sector that they're trying to boost in China, which is a huge user of copper, has that really kicked in yet? You know, so is this a market moving on the idea that that might happen? Or is it moving on the fact of the reality? I think it's still the idea. So right now we've slowed down a bit and we're backing off. But there's one more thing we should throw in here when it comes to a base metal or actually any kind of commodity or metal. And it's what you and I see in the futures market. And it's what you showed us, Jim, just a minute ago with the Aussie dollar. What you and I saw was the dollar was getting stronger. And if the dollar's getting stronger, it means copper prices are also feeling that impact. It makes them more expensive. So they can back off a bit. This action with the stronger dollar for a base metal like this, it's not surprising at all. If the dollar was weaker today, we may not see that. We may see Tom's objective, actually. But with the dollar stronger, that throttles down some of the action we expect for copper. So we have a few dynamics there. Have the controls that they wanted to do been implemented, and the US dollar impact?
Wow. Well, so truly FOMC affects everything.
Yeah. Basically, it's a good summary statement. Bottom line, I would agree with you. It's the most powerful economic entity in the world. You know, people always associate our economy with presidents, you know, and the presidents will take, if things are improving, they're always going to say, look what I did. And if it doesn't go well, they say, look what the other guy did. But really, they don't have much impact. You know, the administration can determine how much money we spend and you know what their budget is and all that kind of thing. But in terms of our economy, yeah, the Fed is the power, I think.
So we're almost up against time. Next time we have to talk about gold and Bitcoin because they've been spectacular price movements there, but we don't have time this particular segment to talk about that. But I appreciate you being on with us today. And what's the best way for people to reach out to you?
Well, I have a website, dangramza.com, and I do a daily video. There's a free one, and then there's more advanced one. The free one is like 2 minutes, 2 to 3 minutes, and the other one is about 10 minutes, depending on what's going on. I look at 22 different markets. In the free one, I'll pull out different ones that we can look at that's happening, and you'll see red and green lines, which imply buy and sell signals. These are not trade recommendations, just ideas that I want to share. And
that's awesome. DanGramza.com, everybody. Dan, appreciate you. Looking forward to getting you back on sooner than later. I hope you have a great day. All right. Well, we're going to get ready for Blu Putnam next. We'll be right back.
So, you want to be a trader? Well, you should know you're not alone. Over the past several years, record numbers of people have set up their very own online trading accounts. There's never been an easier time or more inexpensive way for do-it-yourselfers to get started trading the financial markets.
Better futures start now with the Ninjatrader mobile app. With the power to customize how you trade on the go, you can quickly and easily place trades with a single swipe and view index, financial, energy, metal, crypto, and more futures markets and access over 40 built-in indicators plus custom indicators all from your phone. Stay up to date at all times by enabling notifications. Get started today at ninjatrader.com. Technical analysis made easy. A starting place for new traders. When do I place my trade? Where do I set my stop loss or profit target? All good questions that traders need to answer on a regular basis. One of the ways traders get to those answers is by using technical analysis in a historical price chart.
Join over 800,000 users who trust Ninjatrader as their futures trading platform of choice. Access the world's most popular futures markets and trade seamlessly across devices, including PC, Mac, or mobile. Get started with $50 margins and commissions as low as 9 cents. Need support? We're available 24 hours a day, 5 days a week. Want to personalize your trading setup? Connect with our ecosystem of third-party developers, building trading indicators, and more. Visit ninjatrader.com to get started today.
Better futures start now with the Ninjatrader mobile app. With the power to customize how you trade on the go, you can quickly and easily place trades with a single swipe and view index, financial, energy, metal, crypto, and more futures markets and access over 40 built-in indicators plus custom indicators all from your phone. Stay up to date at all times by enabling notifications. Get started today at ninjatrader.com.
Join over 800,000 users who trust Ninjatrader as their futures trading platform of choice. Access the world's most popular futures markets and trade seamlessly across devices, including PC, Mac, or mobile. Get started with $50 margins and commissions as low as 9 cents. Need support? We're available 24 hours a day, 5 days a week. Want to personalize your trading setup? Connect with our ecosystem of third-party developers, building trading indicators, and more. Visit ninjatrader.com to get started today.
We are back live with the artist formerly known as Blu Putnam, chief economist of the CME, still Blu Putnam. How are you, Blu?
I'm good, thank you.
Great to have you back. I'm glad you agreed to kind of dust off the suit and get back into action after. How's retirement treating you?
Oh, it's incredibly busy, but I'm picking up some little interesting consulting work. I get to be on the show with you. It's all good.
Yeah, well, your timing's perfect. We've had all sorts of central bank activity throughout the world the last couple of days, and we're going right into Chair Powell's press conference tomorrow at 2:30. So all eyes are on the FOMC.
Yeah, they sure are. Of course, the FOMC is going to do absolutely nothing. So all eyes are going to be on that press conference to see if he gives you any hints. And he's probably just going to say, "Hey, we're data dependent. We're not quite sure what's going on. See you in a couple of months."
Well, in the dot plot, we get a dot plot this time too, right?
We do get a dot plot.
So that's something.
Yeah, it is something, but the dot plots have changed. When the dot plots first came out, the various presidents of the regional banks and the board of governors, they were pretty independent about their dot plots because nobody was really looking at them. Well, guess what? The Heisenberg principle works for the Fed too. When people start to watch it, it starts to change. And now that it's such a focus, it's a more coordinated dot plot, and I think it actually has less information in it than it used to. But we'll see. Anyway,
but it seems like the Fed funds tool has finally caught up with the dot plot from December, where it was usually way out of whack.
Yeah, the markets haven't really believed the Fed about higher for longer. And that could be because they thought inflation was coming down faster, or they thought we were going to have a recession. There are lots of reasons why the markets might not have believed. But, now everybody seems to be on the same page, which, of course, means something else will happen.
Right. Something unexpected, of course.
Right.
Well, we're here to kind of focus on this dual mandate, right? Because we still have a dual mandate, whether you like it or not. It didn't go away, right?
No, the dual mandate hasn't gone away. And I think it's worth taking a deep dive into the dual mandate to understand kind of not just the short run thinking of the Fed, but the longer run things that they have to consider when they change course, if they do.
Yeah. All right. So let's keep going. Disclaimer here: this is not investment advice. We've for sure, we know that. And let's get into it right now.
Well, this is just where we are. We're at full employment. I mean, we're under 4% unemployment, and it's been there for a long time, and it's very rarely there. So we know we're going to have a robust job market. The inflation rate's a little trickier because we peaked at 9%. We came down to 3% on the headline. And if you take out owner equivalent rent, we're actually at 2% on headline inflation. But on the one the Fed likes, the personal consumption price index, excluding food and energy, they call it the core, we're at 2.85 with the possibility of a slight uptick. So, we're really in the 3% territory on what the Fed looks like.
Okay.
But let's talk about the full employment mandate first. This is kind of an interesting one. This is the statement that the Fed actually put out last month. It was a restatement with no changes from what they had talked about in 2012. But basically what they say is that, look, the maximum level of employment is not directly measurable, and it changes over time. And so we should not set a fixed target for that. That should be a judgment call.
So interesting that it's not directionally, it's not directly measurable. We've had so many, we have so many revisions, right? We always have these revisions that go 1 month, 2 months, 3 months later. And sometimes, like last time, remember we went, I can't remember, January non-farm payroll was 353,000. It was revised by down by 124,000. That's kind of a big miss.
Yeah, big miss. Let's go to the next slide and actually look at some of this data.
Okay.
because that's the chart on the right you were just talking about, payroll employment. Not only do we have big misses in the revisions, but this is one volatile data set. But it's still performing better than most people thought it would or could. And the unemployment rate, like I took that picture back to 1960 just to show how few times we're under 4%. I mean, we are really, I mean, this is one case where you're pretty sure we're in a full employment situation. I mean, this is a no doubter,
Yeah.
at least for now.
Yeah, but let me ask you this though. It seems like, and maybe there's another slide coming on this, but it seems like job openings are still pretty high.
Yeah. Before we go to the job openings are high, but they've come back down to pretty much pre-pandemic trends. Let's go to the next slide and take a look at a few other kind of measures we look at. Here you go, job openings. If you kind of pencil in the trend there, you can see we're back. If we had been growing, if the pandemic hadn't happened, we'd be about where we might be on job openings with a growing economy.
I could do this with the tool there, right? Just kind of like that, right?
Oh, yeah, exactly. So, job openings are back to pre-pandemic pattern. Voluntary quits are also back to their pattern. So, we just had a tremendous amount of disruption during the pandemic. Data was disrupted, seasonal adjustment was disrupted. People got tons of money from the government. The Fed helped out. So I think we're really in a period now where you can look at the data and start to get some sense of where we really are. And we're in pretty good shape, but the abnormalities of the pandemic are pretty much washed out. Let's go to the next slide though and talk about some other aspects of the what's going on in the labor market. And that's the wrong direction.
There we go.
There we go. We get a lot of attention on the labor force and participation rates. And I think this is somewhat misguided because when people talk about labor force participation, they often talk about that red line, which is the participation of the entire population. That includes your 90-year-old grandmother in there, of course, and she's not working. And so as the economy, well, probably not anyway, but as the economy, as boomers retire in the population, the labor force gets a little older and we're not making quite as many young people as we used to. So you would expect the labor participation in the whole population to be declining. And by the way, that started happening in around 2000. This is not something new. The labor force participation rate that I look at is what are working age people doing? And so that's the 25 to 54, right in the middle of your working zone. And again, we're back to where we were pre-pandemic on that labor participation. By the way, it is interesting to go back to the 60s and 70s. That's when women came into the working force in size and really jacked up the participation rate there. But now we're stable. Now, another thing we have, go ahead.
Yeah, I mean, 70%-ish all the way up to almost 85%. That's a big jump when you consider how large the population was.
Oh, yeah. I mean, that was, improved childcare, fewer kids, double income parents, all kind of things happening there. But that trend really peaked out by 1990. That was a done deal. And so now we've been pretty stable in the workforce. But that's the one we got to look at. And you can see that the pandemic and even the post-Great Recession, we've come back from that. So people are working again. The labor force is worth taking a look at because it's not growing as fast as it used to. The labor force, really depends a lot on how many young people are coming in. And the 15 to 25-year-old age group has very little growth at all. And you have boomers retiring. So labor force growth, we're probably looking at maybe 0.5% a year. And what that means for the unemployment rate is you don't have to create quite as many jobs to keep the unemployment rate from falling because, it's jobs divided or unemployment divided by labor force. So we're probably in a pretty good position to stay around the 4% unemployment rate for quite a long time, unless we were to get an unexpected recession.
So, Blu, I was born in 1963, and my wife calls me a boomer. I always thought the boomers were the kids that were born after the war ended, when the soldiers came back, 1945, 1955, and had some government subsidies and stuff to get housing and all that stuff, and had kids. And now she's including me in that range.
Yeah, you're on the transition period. It was easy to figure out when the baby boomer generation started. Okay, people came back from the war and had a lot of kids. It was a little more difficult to put an end date to it. But most people, they've kind of settled on the very early 60s. So I would say you're barely a boomer. I mean, you really probably, I don't know, do you have a muscle car, things like that? I mean, there's certain, and you weren't really part of the original rock and roll revolution, because that was in the 50s. The Beatles first played in the United States, I think, around 63 or so. So, I mean, you're barely a boomer. So,
well, okay. All right, that's good. She doesn't use that term endearingly, actually. So.
Anyway, we can.
Oops, which way am I going?
We
Down.
can go
Okay.
into the. We can stay with the slides and talk a little bit about inflation.
Well, okay, because I do want to ask you about the last CPI print and all that stuff. So let's keep moving.
Okay, well, this is the Fed's statement about inflation, and I like to contrast it with the Fed's statement about the job market. Here they're saying, look, the inflation rate is primarily determined by monetary policy. That's the Fed. And so since we're determining inflation, we get to set a target, and we're setting 2%. I don't know if the Fed's been paying attention, but they didn't see the pandemic inflation coming. It was probably caused by fiscal policy first, not monetary policy, and the supply chains didn't help. And I'm of the camp that the Fed should take another look at this policy statement, because while monetary policy is very important for inflation, it's not remotely the only thing going on. But anyway, that's my rant on setting targets.
Right. So on the fiscal side, Capitol Hill is going to do what they do.
Yeah, but in the pandemic, they pumped $5 trillion into the economy when it wasn't doing very well, because we couldn't go out to eat or travel. And so a year later, we got inflation, and the Fed supported that with zero rates and quantitative easing. So we had a very grand experiment called modern monetary theory, and guess what? It does cause inflation when it's pushed that hard, and it's not all the Fed. But yeah, fiscal policy now is, they don't have enough money to spend more. So we've gone back to pretty much the past pattern. But let's take a look at the data. Yeah,
just hang on, let me cut you off real fast. The MMT people, though, do argue that, and I think Stephanie Kelton maybe is the person who wrote that famous book, but they do say, listen, you could spend more money, but you got to spend it in the right places, right? You can't just spend it. You got to be infrastructure, stuff like that. And I thought that was kind of a compelling argument.
Yeah, that is the theory of modern monetary theory, is that you treat government spending like an investment. And if they spend the money on a good investment that helps the economy over the long run, then that's more okay than just giving money to people to spend, which is, of course, what happened in the pandemic. So there are some distinctions there. Yeah.
All right, let's keep moving. I don't know which way my mouse rolls. That's why I keep making.
There you go.
There we go. 3%.
Okay, well, here's just where we are. The Fed's favorite target's core inflation based on personal consumption. We're at 2.85. There's a little bit of evidence that might get a slight uptick at the end of the month, but nothing major. So, let's just say we're at 3. But look how long we were at 2%. I mean, a little over 25 years. By the way, during that period, interest rates went up and down, stocks went up and down, unemployment went up and down, and the inflation rate was just a random number generator with a 2% average. Another reason why maybe monetary policy, maybe there's something else going on. One of the things that's become popular is to take the last 6 months and annualize it. So, and you can see on that, we've had a lot of improvement, but that one's kind of gotten sticky. And so people are worried that, hey, you get a lot of talk about the last mile. We got to 3, can we really get to 2? So that's an issue that Fed may very well talk about. Let's go to the next slide.
Hang tight. If we could digress just a little bit here. So we're talking about core. Sorry, Blu. We're talking. I don't mean to slow your roll, but we're talking about core, and that's excluding food and energy, right?
Yeah, and the Fed doesn't drive, go to work, or eat.
Right. So, but the thing that really bothers me is the energy part, right? And the energy part, you have a couple tiers, right? You have what crude oil prices, natural gas prices, you have heating oil, everything that's refined from this stuff. But really, it's not just about us driving our cars, right? I mean, low sulfur diesel powers everything, right? It's the supply chain. So that you're taking out a huge part of what's driving the supply chain by doing that.
Yeah, now remember that this is inflation. So the diesel that the truck consumes while it's shipping your goods isn't part of this, because it's your gasoline that you're consuming, the natural gas you maybe use to heat your house. But you're exactly right. If we get higher energy prices, they feed into everything else with not a very long lag. If you're running a business and you've got higher energy costs, you got to pass it on, figure it out pretty quick. So, to the Fed's defense, the numbers are more volatile, but I don't, if you put energy and food back in, but I don't think they tell you anything different.
Okay. Well, that's good to know. Because I mean, even this pencil, they made it with energy, right? And they transported it here.
Yeah, and it's got graphite in it. So, it's all very interesting. We'll go to the next one and do a little, this is the headline CPI. Again, on the headline, we're at 3%, but you can see we're kind of stuck there in the last couple of months. And then on the right, this is the one that bothers me and a lot of economists, is the importance of owner equivalent rent. It's 25% of the headline CPI. There's another 7 or 8% that's more real rents that people pay renting apartments and things. But this owner equivalent thing is you own your home, you rent it to yourself, you change the price every month. Really, I don't think so. And so, if you take that out, we're at 2%. So the Fed looks at this, but they don't want to mess with their target. They don't want to mess with their choice. That would give them credibility issues, and they got plenty of those already. So they backed themselves into a corner that they really don't. They just want to wait on the headline of the personal consumption price to come down. But by at least at one measure, we're already reached 2%. Other measures, we're at 3%.
So that begs the question, how long do we have to meet that threshold or be below that 2% threshold before the Fed is comfortable?
Let's go to the next slide and talk a little bit about that. We get some better pictures here. The Fed is going to be comfortable when it feels like enough of the pieces of the puzzle have stabilized. So, the food and energy are fine. Goods are fine, durable goods. Wage inflation is just a little bit above the rate, the 3%, and that's a healthy place to be, so it's not a problem. So let's go to the next slide and see where we might try to answer your question. Here we go. So the Fed, on the right, you have the Fed's measure of the Fed funds rate, and you have the core PCE inflation rate. You can see interest rates are pretty far above where we are now. What the Fed absolutely does not want to do is cut rates and then raise rates. They don't like that at all. So how long do they have to wait? They need to wait to make sure that the slightly hot inflation readings we've gotten in the last 2 months, and by slightly hot, I mean just a tenth or two. I mean, barely hot. But still enough to give the Fed cause for concern that, hey, wait a minute, we don't understand what's going on. And there's no question that they don't understand what's going on. I mean, their track record with this inflation surge is just not good at all. So I think they probably need 3 or 4 more months of monthly inflation data that's subdued.
I got it. I mean, the thing that struck me on this, I was looking at this last night after dinner, and I was looking at the left-hand side, and I didn't realize most Fed funds rate is above PCE core most of the time.
Oh, with the exception of Greenspan put in 1% rates right after 9/11. So you had about 3 years there. And then Bernanke put in 0 rates after the Great Recession. And that pretty much stayed all the way through the pandemic with a little bit of an exception in 2018 that got reversed quickly. So, you know, if you go through history, short-term rates are above the rate of inflation. And why? Well, you need to be compensated for what's going on in inflation. You know, the outlier period, which I don't think we're going to go back to. I think the Fed has learned that wasn't the greatest idea, is keeping rates below the rate of inflation. By the way, Bank of Japan hasn't learned that lesson, just the Fed.
Well, they took a step in the right direction last night, didn't they?
You would call that a step? From minus 10 basis points to plus 10 basis. I'm not sure that baby can walk yet. That wasn't moving very much. And of course, a lot of people had thought when the Bank of Japan, you know, started to exit negative rates that they'd get a nice little rally in the end. Well, you know, buy the rumor, sell the fact. That didn't work. Anyway, that was a little digression. But the Fed probably is much more attuned to finding a level for the Fed funds rate that's somewhere above the prevailing inflation rate. So maybe 1.5 or something. So if you're a 3% inflation person, the Fed could go to 4.5, and if you're a 2%, they can go even lower. The Fed is definitely not in the 2% camp yet.
Yeah. So, and it doesn't seem like the equity market cares.
No, the equity, and for good reason. The U.S. economy is not particularly interest rate sensitive. The real economy. I mean, if the Fed were to raise rates another percentage point or lower them 2 percentage points, is that going to change NVIDIA's strategy, Apple's strategy, or the EV strategy from the car makers? No, it's not. They're taking a much longer view, and small changes in interest rates are not part of that equation. Big ones, if we went to 10% interest rate, sure, that would matter, but we're only talking 1% or so here. And it's just the economy. And one of the reasons the economy isn't very interest rate sensitive, there are a couple of reasons, but the big one is that we do a lot better job on risk management. I mean, go back to, when the boomers before you were born in the 50s, there were no interest rate futures, okay? Interest rate futures didn't show up until the late 70s, and they didn't really take off until they became electronic or, in the late 90s. So we've really just had 25, 30 years of active risk management with interest rates. And, if financial institutions and companies do a better job managing their interest rate risk, guess what? The economy is not as interest rate sensitive as it used to be. And then, of course, we used to be a manufacturing economy, and now we're a service economy. Services, you don't generally mortgage your house to buy services, okay? So, but in the manufacturing economy, you did borrow money to buy a car, and you still do that. But now that we're much more service dependent, services are not as interest rate sensitive as manufacturing. So there's some really good reasons why the economy is significantly less interest rate sensitive, which of course means that if you're a central banker, you're way less powerful than you thought you were.
Is this a cyclical thing though between manufacturing and services over the years, or are we just entering new territory right now?
It's a secular trend. As economies grow, become more mature, services become a more important part. So you look at like China, it's not really an emerging market economy anymore, but 20, 30 years ago, it was really all about exports and manufacturing, and slowly but surely they're becoming more service oriented. It takes time, it takes growth, but as an economy matures, services naturally become more important. You travel, you eat out, a lot of the things you do are more service oriented.
Yeah, that makes sense. That makes sense. I'm guilty. I'm doing a lot of that. It's easy to do here in Charleston, though, Blu, with all the food that's down here. So it's easy.
It is.
Man.
But let
Anyway.
me close on one last question that you haven't asked. And how much credit should the Fed get for inflation coming down? And I would answer only about a third. There's no slide for this, by the way. It's
Okay.
my Uncle Bill used to always quote Will Rogers. Hey Blu, you want to get out of that hole you're in? Stop digging. And we had a fiscal policy expansion that we don't have anymore. We had zero interest rates. We don't have that anymore. And we had all kind of supply chain disruptions, and they're slightly disrupted now, with the Panama Canal and Suez, but that's nothing like what was going on during the pandemic. So, the Fed's only one part of those three things. So I'm going to give them 1/3 credit.
Yeah, but all right. So let me, for the 1/3 credit, what about the housing market? I mean, when rates were so low and the mortgages followed so low, and a lot of people have 3% mortgages and 3.5% jumbo mortgages, they all upsized. Everybody upsized. And when you upside, you spend more anyway with stuff like lawn care and energy and, heating, air conditioning, all that stuff. So that kind of added to people's costs.
It added to the cost, but that was, pre-pandemic. And now that we have higher rates, people that have those low mortgages are locked in. They might want to downsize or change their house or do something, but the thought of exchanging a 3% mortgage for a 7% doesn't work. So we have one of the most unusual housing markets ever. Another reason why shelter should not be controlling the Fed's decision on rates.
Yeah, that makes sense. I know it's a little wacky, but we'll see. I mean, boots on the ground here, Blu, is everything is just churning along. I mean, we have construction everywhere. We have infrastructure projects that are breaking ground right now. The restaurants and the brew pubs, that's a big thing down here. I guess they're called micro breweries now. Jam-packed. It's almost like what I would imagine the Roaring '20s were like.
Yeah, we can only imagine. By the way, we're not going back to the Roaring '20s, because in the Roaring '20s, the demographics were we were a very young country. So there are some plenty differences there. But, if you come out of a really difficult period, it's not unusual to get productivity and growth. And that's because the weaker links get knocked out and the stronger ones get to play a little more aggressively, and the economy does better. And we're seeing that.
Yeah. So we got about 30 seconds left. What should we look for any surprises tomorrow?
No surprises tomorrow. The Fed goes out of its way not to surprise. Jay Powell has been taking courses in how not to surprise. We'll see if he's gotten any better. It's the off-the-cuff answers to questions that can get you in trouble. The prepared remarks are never a problem. But the Fed's, it's going to be cautious. Its forecasting track record isn't very good. So it's not really very clear about where the road's going ahead. So it's going to drive slowly. In fact, it only drives looking at the rearview mirror, which I find extremely dangerous, but that's another topic.
Well, I'm going to have you back on Thursday. We'll be able to analyze what happened on Wednesday. So I appreciate you willing to do that, and also your time today this morning.
Okay, thank you. It's a lot of fun. Thank you.
All right, talk to you soon, everybody. Thank you for everybody. We have coming up next Larry Williams in a couple seconds here. We're going to take a really quick break.
So, you want to be a trader? Well, you should know you're not alone. Over the past several years, record numbers of people have set up their very own online trading accounts. There's never been an easier time or more inexpensive way for do-it-yourselfers to get started trading the financial markets.
Better futures start now with the Ninjatrader mobile app. With the power to customize how you trade on the go, you can quickly and easily place trades with a single swipe and view index, financial, energy, metal, crypto, and more futures markets, and access over 40 built-in indicators plus custom indicators, all from your phone. Stay up to date at all times by enabling notifications. Get started today at ninjatrader.com. Technical analysis made easy. A starting place for new traders. When do I place my trade? Where do I set my stop loss or profit target? All good questions that traders need to answer on a regular basis. One of the ways traders get to those answers is by using technical analysis in a historical price chart.
Join over 800,000 users who trust Ninjatrader as their futures trading platform of choice. Access the world's most popular futures markets and trade seamlessly across devices, including PC, Mac, or mobile. Get started with $50 margins and commissions as low as 9 cents. Need support? We're available 24 hours a day, 5 days a week. Want to personalize your trading setup? Connect with our ecosystem of third-party developers, building trading indicators, and more. Visit ninjatrader.com to get started today.
Better futures start now with the Ninjatrader mobile app. With the power to customize how you trade on the go, you can quickly and easily place trades with a single swipe and view index, financial, energy, metal, crypto, and more futures markets, and access over 40 built-in indicators plus custom indicators, all from your phone. Stay up to date at all times by enabling notifications. Get started today at ninjatrader.com.
Join over 800,000 users who trust Ninjatrader as their futures trading platform of choice. Access the world's most popular futures markets and trade seamlessly across devices, including PC, Mac, or mobile. Get started with $50 margins and commissions as low as 9 cents. Need support? We're available 24 hours a day, 5 days a week. Want to personalize your trading setup? Connect with our ecosystem of third-party developers, building trading indicators, and more. Visit ninjatrader.com to get started today.
Well, good morning. Welcome back. Here we are with Traders Workshop. This is the Traders Workshop segment of our live stream, and Jim has taken a nice break and let me take over because we are very pleased to welcome back to Traders Workshop, to the Ninjatrader live stream, one of the legendary greats of trading, Larry Williams. Larry, how you doing today?
Well, Tom, I've been in and out of bed the last couple of weeks with pneumonia, so I'll be coughing a lot today probably, and my voice might be a little broken, but the show goes on, so I've got a lot of things I want to talk about. So I'm here. We're going to have a good show today.
Well, and we really appreciate you coming on. By the way, this is our second full day of doing this new format, and we couldn't have been more pleased that you agreed to do this time slot with us. And hearing that you were sick, of course, we're really grateful that you can power through. But you mentioned some of the markets you're going to talk about. I'm excited to see what it is. But how have you been otherwise? It's been about 3 months since we've seen you. Everything good otherwise?
Yeah, everything's been good. I'm almost 82, still trading. So and that's what a phenomenal life. Happily married and and trading with a good deal of success. So what could be better? Yeah, everything is fine. Except we went to a fundraiser down here for the local country day school, and there were a lot of, I don't know, a couple hundred people there. And the next day, this thing started. I've been battling it thanks to modern science and antibiotics. I think I finally turned the corner. But you know what probably really did it was I knew I had to be ready by today for you. So I think that was a big motivation. And to explain what I calling my Jesse Livermore trade in soybeans, I'm really excited about a trade here. So that's been part of the motivation to be here as well.
Well, we really thank you for that. And maybe Mission Control, if we could go to the chart, because when you said Jesse Livermore trade when in your email, I can't wait to see what it is, because we've all heard about Jesse Livermore, Confessions of a Stock Operator, but how is that applied? It's rare to see that applied. I think when people read the book and they say, well, what does that mean? It's a lot of stories, but to hear somebody like you talk about what that is, I'm very interested to hear.
Well, I've been reading a lot about Jesse Livermore this year, and there's a lot of wisdom, and not the Reminiscence book, but a couple other autobiographies that have been written about him. Clearly, he was the most successful trader of all times, made $110 million in 1929 crash, which would be $100 billion today. And he was also the most spectacular failure in the market. He lost all that money and he ended up committing suicide. So he had a lot of good things going for him and a lot of bad things. And I tried to figure out why he could be the best trader and the worst trader. And I think I really nailed it down. Consistently in all of his trades, as you look at them, he never used any money management. He had no risk control. Probably because he began in bucket shops where you'd put up $100, and if the stock went down $100, you're out. If it went up, you made a lot of money. So there was kind of an automatic risk control, like an option. So he never really learned money management. And so he was a plunger all the time. But he did have some phenomenal trades. And one of the rules or understandings I got was that the difference between a gambler and a speculator is a gambler's like flipping a coin. The market's going to go up for a day or down for a day, and that's a gamble. But a speculator, which Livermore saw himself as being, is somebody who can perceive a large move in the future. But even at that, Livermore adds, he would test the market by buying, and if he was wrong, he knew immediately he lost money, he would get out. So ultimately, his strategy developed to be buy new highs. So if we look at this chart of soybeans, it's on a weekly basis. Clearly, if you start looking at, say, 2021, huge run up in the market, probably precursor of it was a red line, which is a net long commercial position. The commercials, I think, are the smartest guys in the market. And if we look at where they are now, this is the largest net long position they've ever had. So they're extremely bullish on this market. And if you look at the high levels going across, you'll see that almost always, when they've been this successfully bullish in the market, soybeans have rallied. The question is and that was another thing Livermore talked about. He said one of the elements that took him a long time to discover was timing, when to get in. And his solution to timing was simply wait for a breakout, because with prices run, look at the long-term chart. When they start to run, they run. So I think that's the setup that we have right now. Commercial, wildly bullish. And in this complex, soybean oil has been the strongest. Typically, soybeans move more a soybean meal moves more in a bull market. But this year, soybean oil has been the strongest of the complex.
So Larry, real quick, is there a little bit of an offset with that commercial, the commercial traders, commitment of traders, commercial portion, that line down there? So it looks like they lead the market just a little bit. Is that what I'm seeing there?
Sometimes, like where I show right now, they're right at the bottom. If we look over here, they just got net bullish right here, right at the bottom. And sometimes they're early. So they're not a timing tool. They're a setup tool. And I think that's the big lesson to learn from the Commitment of Trader report, that was a condition when you would expect, as Livermore talked about, a significant move to take place, but you still have to add the other element he talked about, timing. So yeah, it's wildly bullish. In fact, I bought soybeans a while ago, got stopped out, lost money in it. And I'm long beans now. We'll see what happens. But what I need to really make this a successful trade is to see the market move and get a trend change in the market. Maybe I can get let me move my charts a little bit here. I've got a little different setup on this. And we can look at another chart that I had. Hopefully, let's see if I can do this. No, I can't. Well, what I'd like to see next would be to see on a daily basis, price get above an 18-day average, a 50-day moving average. Then we know we're in an uptrend, Tom. So that's the next thing to look for, to know we're in a significant trend change. That's really important to find that next.
Okay, so you said 18-day and 50-day, or
either one. It depends on how close you are to the market. If you're really close to the market, then you'd want to look at an 18-day average or 50-day average. Anywhere in there, I think is going to work for us. So that, but all that's doing, in Livermore's terminology, saying the trend's up. Right. And his theory is when the trend is up, you want to buy breakouts to new highs. You don't want to be buying pullbacks. You want to buy breakouts, and most people don't want to buy breakouts to new highs. They want to buy pullbacks in the marketplace. And he was very clear. He didn't want to buy pullbacks. Now here we see the 18-day average in soybeans. And you can see where we are now. We're above the 18-day average, which means the trend's up. Now we don't know how long it'll stay up. But the fact that commercials are net long is pretty bullish, suggesting we're in a trend move now. So a breakout to new highs would be a buy point in the market, or whatever. You can use trend lines, whatever you use. There's so many tools now. Right. You want to be willing to buy strength because of the bullishness exhibited by the commercials.
It's taking that momentum idea and having the market prove that you're in the right direction, right? If you're bullish, prove it to me. Break out of this area, break out of this level, and continue on that momentum.
Right. There's a reason to be bullish. Your commercials are heavily long. They're really bullish. They own a lot of soybeans and meal and oil. So that's a condition, but it doesn't mean we'll rally right now. So let's say, okay, let's wait for the trend. I mean, they were bullish back in February and the market continued going lower. They continued buying more, by the way. But now, finally we've turned the corner. And so let's buy strength as opposed to buying weakness in the market. That's a Livermore trade.
Yeah. And to be fair, Richard Dennis, I think, had some of that philosophy as well, right? He would buy breakouts, and that's what he taught his turtle traders.
The turtle trader said, we can't predict the future. We don't have any idea what's going to happen in the market. So we'll buy every 50-day breakout, sell every 50-day low. Well, I think you can tell when there's going to be significant moves in the marketplace. They, of course, to do the turtle system had to be in 50, 60, or 100 markets. They didn't know which one was going to run. It's like putting a chip on a roulette table. One of the 37 chips is going to have a move. You don't know which one's going to win.
Right.
But I think we can tell when we're getting one that's going to win based on seasonal commitment to trade report, accumulation in the market, a few other indicators. I think in the bean complex now and in grains in general, we're in a condition where we should see them rally. There is a bias to this market now, clearly.
Great. That is that chart that is, I would say, classic in terms of that turn up of the moving average off the low. You're not going to get the bottom of the market. You're not looking for the bottom of the market. You're looking for a proof of trend. And, commitment of traders, cross of the moving averages. You throw in a momentum indicator, a volatility indicator to help you, maybe do a little bit more timing with the volatility. And, that's a little more to the puzzle that you could do as a trader.
I think the money in the market is largely lost buying bottoms and largely made buying strength. Mm-hmm. And it's so contrary because we all want to buy low. We go to Costco because prices are cheaper there. We want to buy low. And there can be a time for that, but to be very careful, very discriminatory of that. But buying strength usually begets strength. So we got a market that's set up. I'm interested in buying a new breakout high in this market.
So you mentioned bonds. I think that was the next, you want to pivot to bonds because it's been behaving a little interesting. We've been looking at the 10-year, you could talk 30-year, but the treasuries in general. it looks like there was a bottom, a possible bottom put in, but with all this talk of the Fed, delaying the cuts, it seems like, well, maybe bonds haven't priced in a bottom yet. So just curious on your take. That's our take a little bit.
Well, I am short and I'm really close to my target. I mean, just a couple of ticks away. So I'm really nervous. I brought my stops way down today. But in terms of a longer term perspective, we're looking at a weekly chart of bonds. And the blue line is a forecast that I made in January. Let me go back a chart here.
Okay, we're not seeing it on our screen.
Yeah, hold on a second. Let me see where we get that from. Let's see. We're going to have it for you in just a moment here. Does that show now, Tom? We should see that now.
I see soybeans as well.
Yeah, so we're just about there now.
Sure.
Okay, that one. And we're working on that,
There we go. See your cursor. There we go.
Bear with me a second.
Sure, no problem.
Sorry about that.
So by the way, Larry, what we've done too is we've opened up our chat room on the YouTube channel.
Okay.
So people can drop in questions if they'd like. We do have somebody watching the YouTube chat. We have our regular chat, and they can send us questions if they like.
Okay, so the blue line is a forecast, cycle forecast. And cycles are good. They're a tool. They're not perfect.
So Larry, I'm still seeing the soybeans chart.
Oh, you are still seeing soybeans.
Maybe you shared one panel of Ninjatrader instead of your screen. That's what I'm thinking. And that's fine.
No, we're not back there. I'm sorry.
That's okay.
Okay, let's try. Tom, I apologize for this.
That's okay. That's okay.
Let's just, I'll try to talk through it.
Sure, sure.
In terms of long-term cycles, what we're trying to bring up the screen, Treasury bonds, starting with a forecast done in January 2022, have shown a significant low coming up in April. And of course, that was made a long time ago, and these cycle fluctuates quite a bit. The current forecast shows the exact same time period. Now, typically, bonds rally, really interesting point, when people pay income taxes. It's very surprising. You would think that when people pay taxes, stocks would come down and bonds would not rally. But in fact, it's really a bullish time in the stock market, usually for short-term trades, as well as the bond market. So that kind of fits in the seasonality of the bond market. And I see cycles are saying we're going to set up a buy point maybe between the 8th and 15th of April. I think that is the next significant large move opportunity coming in the bond market. That's based on a cycle forecast made over a year ago, as well as the most current cycle forecast. So I think there's some real opportunity there. Now, do you see that chart?
Let's see. I think what we can do, Larry, is
see the bond chart.
Let's see. No, we're still on the. So I think what we can do is maybe unshare your screen, and then
unshare our screen.
Right, in Zoom, and then we can reshare.
I'll stop share.
Yeah, stop that share, and
then we'll go share screen again, huh?
And we'll just do the.
We love high technology.
Yeah, no, this is great.
Okay, now
we'll reshare that maybe the entire screen, and then you can just move over the charts as you want. This new format, we don't have as much time to set up. And so,
how about now? Okay, there you go.
That's perfect.
So you can see that area that I've circled. That's the cyclical low coming up. It's around the first part of April, the middle of April. Again, I don't expect these to be specific right to the day or to the week, but generally we see bonds should have a significant up move between now and into July. We saw that the forecast for an October low, which is a great rally in the market. The reason I'm short now, I have been, because you can see the cycle forecasts have been to the downside. So I think we do have an opportunity coming up in the bond market. And that's one that I really want to pay attention to.
And Larry, when you say the bond market, are we talking 30-year? Are we saying just the treasuries in general? Is this a blend? What is this?
The 30-year bonds.
30-year bonds. Okay.
Yeah.
So we might expect something similar if we trade 10-year or 2-year.
Yeah, they all rally together.
Exactly. Okay.
Yeah. So let's look at our next chart. This is a chart for the stock market. We'll switch gears. If bonds are going to rally, what does that mean to the stock market? I'm not certain, but in terms of an overall view of the stock market, there's two really interesting things going on. First is my cycle forecast that we see here. Just because we see that great big line coming to downside doesn't mean we'll have a massive decline, but it suggests that we should see selling pressures until May in this market. That's what cycles are saying. If you look at the commitment to trade report in the stock indexes, we see they've been also on the short side of the market. So I think we have some reason to be looking for sells in the stock market at this time. But we're still in a bull market. I'm clear of that we'll see prices higher this year, especially after the election. But right now, I think there's a reason for some short-term selling in the market. One of them, Tom, let me see if we can get our next chart here, is going to be the difference between what we've been seeing in the Dow Jones Industrial Average and the S&P 500. This is really interesting what's taken place here. I'm going to try to pull up the next screen. The Dow Jones average, as you know, represents the more quality stocks in the market. The S&P is a more speculative group. The NASDAQ is probably the most speculative group in the marketplace. And I think we can pull up a screen now.
I think we're seeing that soybean screen again.
Yeah, we just love to show the soybean chart, don't we?
I think it's subliminal. By the way, Larry, lots of well wishes for you to speedy recovery from the chats. We can't possibly put in every comment. We'd spend
I
a
appreciate
whole half
that
hour
very
reading
much.
it.
They are been significant. So typically, when a stock market tops, the more speculative stocks will stop and start to decline after the broad averages have. As you see now on the top, we have the Dow Jones Industrial Average, the YM contract. It made its high way over here, and the broader based S&P is up here. So the quality stocks really topped way over here. In fact, and Tom, this is something nobody's talking about. Look what we have here. We have a shoulder, we have a head, and we have a shoulder. We have a typical head and shoulder pattern formation. Where's your sell point? Real easy, drawing a trend line right up here. Penetration of that, to me, would be a significant trend change in the marketplace. That's what to be looking for here. So I am disturbed that I see that the Dow has been weaker than the more speculative stocks. That's usually how stock markets top.
Yeah, and you know, Larry, the head and shoulders formation, that can also be used as a target, if you will. Once there is penetration of that neckline, you can use that distance from the neckline to the head to identify a possible target with no time projection, right? It's just a price target.
Correct. And this would be another Livermore trade, right? Because if we do take out that trend line, we may not. But if we do, that's a trend change. And now with the trend, which based on the pattern and a couple of other things look negative here, that's a great point to be negative in the market or protect your long positions. Say, whoa, wait a minute. The cycles, the ball game has changed for right now. So let's acknowledge what's going on. So we see a lot of the hot stocks, NVIDIA is broken, SCMI is broken. A lot of stocks have not performed suddenly like they have in the past. So we see some deterioration in the list. And now it looks like we have this divergence between the Dow Jones Industrials and the more speculative stocks. And that's usually how tops are made. The bottoms are interesting and different, Tom. Market bottoms, usually the speculative stocks bottom first. Because speculators come in and start buying those stocks, and the Dow tends to bottom after the speculative stocks do. So if I see a lot of money coming in speculative stocks after a decline, that's bullish. But after a rally, just the other way around, it's bearish.
Interesting. You know, there are a couple of things in my mind. You've talked about the election year seasonality. You know, it seems to me that you know, going back to your projections in the stock market, it's coming at a time, you said, you know, not the intensity, but the pattern was down, right? Stock market, it projects a little bit of a retracement. We don't know how much, but that kind of goes in line with the election year seasonality, which has been traditionally April into May. It's a pullback, but then the rest of the year we see a little bit of a lift right through the rest of the year. What are your thoughts on that? Is that something that's accurate? Is that something that obviously we can't say what's going to happen, but we can talk about what's happened in the past?
Well, Tom, we can say what's going to happen. It doesn't mean it's going to, though. That's the
Right.
problem.
Right. Right.
Excuse me. But yeah, that's typical. The big point, though, in terms of a longer term, as far as I'm concerned, that's where the big money is. Are we in a bull market or are we in a bear market? I've been very clear since January 1. We are in a bull market. So it means you want to buy pullbacks in the bull market. You want to sell big rallies in the bull market. You don't want to get caught up by the Cassandras of purveyors of pessimism. Prices will end the year higher, but there's going to be a real strong oversold point in this market. Can we say when? I think probably May, June. And so I'm prepared for that. If it happens, then whoa, man, all the chips go across the board because we are in a bull market. So don't get carried away by the pessimists out there, the perpetual bears. Ain't going to happen. We will stay in a bull market for another maybe year and a half. Then I think it may be time to get bearish. But for right now, don't get sidetracked by all these little short-term things. Think bull market. Think what's the correct strategy for a bull market.
Got it. Got it. Speaking of bull markets, I think, we can touch on gold, if you don't mind. Your thoughts on gold.
Gold had a really interesting run up. The cycles called that one perfectly. It had a huge run up. Right now, though, my cycles are suggesting gold's going to come down for a while, probably another couple of weeks, and then look for a bottom in the marketplace. I thought about selling it short. I'm not short gold. I'm looking, I don't know, not quite what I want there, but I think that we'll see selling pressures to the downside in gold for maybe another month, then a buying point coming. So that's, I'm not always clear on all these markets. I don't have really good vision, let alone perfect vision in these things. But generally speaking, I don't think this is the time to rush in and buy gold. I think there'll be a better time coming up to buy gold. I want to look at the commitment to trader report. I want to look at the small traders. They tend to do exactly the wrong thing in gold. So when they get very bearish on gold again, I want to be a buyer.
Well, that's a great point, which is seasonality is great, but you have to have other things to back it up, right? It's not just one tool in your toolbox. Or it is one tool in your toolbox, but it's not the only tool in your toolbox. And you want to complement it with other examples of evidence, right?
In high school, I had a locker on and I had a combination locker, right? In high school, you put all your stuff, and it wasn't just one number to open up the lock. You had to go 3 left, 4 right, 3 left, 1 right, and then it opened up. And I think that's what it is in the market. You can't just have one number and the lock opens up to instant profits in the market. It's a combination of things, and of course, the more of those things there, the better it is.
That's that. I'd never heard that, Larry. That is a great analogy. I love it.
Thank you.
I think, this is anything else you want to mention, Larry? I know, we're running up against time a little bit, but is there anything,
Well, I think the important thing is watch that trend line in the Dow Jones Industrial Average. Prepare for a bond point around the 10th, maybe 8th of April, somewhere in that time frame. Look for a trend change to get long the market. I think that's a significant setup coming. And the soybeans one, I probably should be long soybean oil. That's been the strong one. There's actually been a flirting with a premium there. So look at the entire grain complex, especially beans. Look to see if there's a premium developing. That would be very bullish. And the big thing in that soybean complex, buy a breakout. Don't try to buy the bottom in here. Wait till the market has pulled back a little bit in here. When it starts to make new highs, that's the point you want to be a buyer, because the market's ignited, start to move in a direction. And as my dad always said, it's a lot easier to ride a horse in the direction he's going than the direction he's not going. And that's really the truth of the market. Right. Why don't you hop aboard something's going up? Why do I try to buy something's going down? Because we think it'll go up. Now ride the horse in the direction the horse wants to go. Much easier.
Well, Larry, thank you so much. Great advice. And thanks for coming on to the show and being an early guest in the new live stream, and we look forward to having you back on. How can people reach you?
I prefer they don't, but if they want to go to our website, it's ireallytrade.com. And it's always an honor to be on shows like that. I think at my age, people want to listen to me talk. So I really appreciate that. I respect being asked to be here. And those who watch, I want to thank everybody for the support and follow my work over the years, of course, as well. I appreciate you being here.
Well, thanks again, Larry. Hope you feel better. And we'll be doing this again soon, hopefully. In the meantime, we're going to take a quick break and we'll finish up with Mike Burke.
So, you want to be a trader? Well, you should know you're not alone. Over the past several years, record numbers of people have set up their very own online trading accounts. There's never been an easier time or more inexpensive way for do-it-yourselfers to get started trading the financial markets.
Better futures start now with the Ninjatrader mobile app. With the power to customize how you trade on the go, you can quickly and easily place trades with a single swipe and view index, financial, energy, metal, crypto, and more futures markets, and access over 40 built-in indicators plus custom indicators, all from your phone. Stay up to date at all times by enabling notifications. Get started today at ninjatrader.com.
Hey, good morning, good afternoon, wherever you are, whatever you're doing. Welcome to our midday wrap up. I'm Michael Burke, your host for this segment, and I'm privileged to be joined by Tom Snyder, CMT. Good morning, Tom.
Good morning, Mike. How you doing?
What a day! Three amazing guests back to back to back. If any of you missed any of those shows or the morning segments, you can always watch the replay. That'll be live on YouTube and on the Learn section shortly after we finish up this segment. But just an incredible day. I mean, they're just all three great guests. It's hard to pick your favorite.
Yeah, it's there's so much information that is running around in my brain right now. I haven't even had time to digest what Dan said, what Blu said, and then keeping up with Larry. I mean, that had me reeling. So, happy to have everybody on, Mike.
Yeah, it's awesome. Tom, tomorrow is FOMC. They will be announcing no rate cut, would be my guess. I'm going to go out on a limb there. You and Jim will be hosting a special client-only event during that event, right? That starts at 1:45?
Right. 1:45 for Ninjatrader clients. You can log into the website. If you don't have a login, you can just sign up. All you need is an email address. And then at 1:45, Jim and I will start the show. We'll be bringing on special guest Stephen Jonathan. We've had the pleasure of having him on before. He's a pretty senior chief economist type level a person. I worked with him for years at Bloomberg, and this is his thing. He lives for analyzing central banks all around the world. So we're going to bring him in. He's going to give us a little bit of analysis on the statement itself. We know there's not going to be cuts, but there will be some information in the statement, pretty sure, that Stephen will dissect, and then we'll stick around for the first part of the press conference. We might see some movement in the market, so we'll be here for about an hour or so, maybe a little more, and just kind of walk you through the cycle of that first hour.
Yeah, I mean, everyone is looking for guidance on, if there's going to be a rate cut this year, when will it happen? How many will there be? I'm in the camp that, we'll be lucky to see one rate cut this year. which is kind of an outlier. But yeah, it'll be interesting. Each one of these brings something new to the cumulative knowledge of what's going to happen next. We nobody knows, but we can get an idea here.
Yeah, and I think was it Blue that was talking about the dot plot earlier in the show with Jim, and the dot plot is what each voting member essentially thinks where the rates will happen, or how many rates will occur during the year. And that they published that, I think, in December, but they revise it every so often. And if you said 0 rate cuts, which one of the governing members did, I think they were kind of, wow, that's crazy. But we haven't had one yet so far. So yeah, if we have one, I'm kind of in your camp, Mike. I think we need a little more of prove it on the inflation coming down to see those cuts begin. So
totally agree. So Tom, the Dow is the only major market index above water today. Actually, the Russell is peaking above the waves here. But interesting, this has been really just a steady slog all day from the open all the way up. There's really been no pullbacks. A little bit of consolidation there during the opening range, but pretty amazing. Let's look at that Dow 10-minute.
Yeah, so I kind of have our standard intraday studies, which are pivots, previous days, high, low, and close in the triangles. We've got the opening range, I believe, here somewhere. It's so hard when there's so many things on the chart. Yeah, right here, opening range high and low, and this market just keeps going up. I mean, that's for some reason the Dow has caught the bid, and RSI intraday is looking pretty bullish at 83. I mean, it's overbought, but it's there for a reason. This market has not really come back since about 8 in the morning.
Yeah, I mean, RSI is one of those indicators. Certainly it tells you whether the market's overbought or oversold. But because of the way it's calculated, when it first moves in, above 70 into that overbought territory, that's often an indication that the market trend is speeding up a little bit. So it doesn't necessarily just bounce off of that overbought level. It's almost an indication that the trend is strengthening.
Right, and we can see here, this is where it crossed above 70, right around the 1030 to 1040 area, and that was where it kind of accelerated right there, 1040. It didn't hold back this market. In fact, it just kept going, and right now you see some pretty big candles as well. So this could be a rotation kind of play, right? Rotation into something a little more secure, like Larry mentioned, kind of the not speculative part of the market. It's more of the blue chips, right? That's the Dow.
Yeah, there's a couple of things here that's interesting in the chart that makes me think that this market is going to be even stronger here in the afternoon. You'll notice, I don't know if you have it on your my 10-minute. There was a volume a little bit above average at the 1050 level, and and just the last 10-minute bar had volume that was a little higher than normal. So you're kind of seeing these little smiles in the volume intraday with higher volume each time we get these little jumps. And in my mind, that is bullish for the market, as we're seeing volume spikes during the middle of the day. Normally, you don't see volume spikes during the middle of the day. And granted, these are small spikes, but in my mind, that's also bullish.
Right, exactly. Something's bringing buyers in here, and it could be the acceleration of price right before. Look at that. That's not as much volume on this candle, but the market's reacting to this big move. So buyers come in, and it continues that trend. Here we saw here, well, this is a big candle, big volume. That's confirmation. That's confirmation of the trend, Mike, that you agree with you that when you say that this could continue the trend all day.
So, right now I'm seeing that this market is starting to drag the others up with it. So the others were a little bit weaker. The ES just popped above 0. The NASDAQ is down, almost 0.5%, but it's starting to rally a little bit here as well. I think the Dow is pulling everybody up.
We could take a look at that, Russell, making new highs on the day. a little bit of the same volume action here, right? A bump in volume. Buyers are coming in, and maybe they don't want to miss the party, right? It's let's jump on this trend, kind of to Larry's point, right? Jesse Livermore, prove it, breakout. Wow, we made a new high. Buyers are coming in.
Yeah, definitely. Let's take a look at Bitcoin. Bitcoin was having a rough day. It's recovering a little bit here. We were in the 63,000s, over 6% down at one point here. So, what do you think about Bitcoin? Is this just, I mean, if you look at the all-time highs in Bitcoin over the last, well, since forever, typically you get that all-time high, and then there is a significant sell-off from that. And this is I think the third or fourth time that that has happened. That the question is how far can this go down, right? And how long will it take for this market to make another new high?
Yeah, and so, one of the tools you can use is how far can it go down is a retracement tool. This is a daily chart of Bitcoin. We'll go to the intraday in just a moment. So from a longer term view, you might take this, and I've got my Fibonacci retracement. I don't have the harmonics on like Jim does. I'm going to use the standard out of the box kind of Fibonacci values, and just above, let's call it 61,000 is a 38% retracement. That's a classic fib number. That's probably 38 and 61 are the most important fib numbers, I would say. So this market might find some support at 61,000, but it still has support at this 20-day moving average. So my thought is if it breaks the moving average, if it falls below, then 61,000 is the next area of support. It just happened to test it here. Well, it's a little lower. This low is, let me just get that lined up. That low is a little lower. It's 60,125. So a little lower than that 61. And by the way, it didn't know about 61,000 as a 38% retracement because we hadn't made the high yet. But interesting levels sometimes manifest themselves. The top of this candle is around 61,000. It's a psychological number. But we still have to break through to this 20,000. And that might be part of the rally in the intraday chart is saying, hey, we're getting near this moving average value, and we're going to stay above it. This moving average value, by the way, is 64,086, so 64,000 roughly.
I mean, these are crazy numbers, right? So from the high to where we are now, it's a 15, maybe a 15% move or more in a week on a,
right.
On a 60,000, that's $10,000 in a week on this. So that's a significant move. You'd be hard pressed to find another futures market where there's a 15% swing in 5 days. So the volatility here is just incredible. The thing is that as volatile as that is, the micro Bitcoin futures are such a small size that you can manage that risk. You can manage that volatility because that micro is such a small size contract.
Right. And you mentioned 63,000, even lower we went today. We were up in the 68s to start. So you're talking a 5,000 difference on 68,000. That, I don't know, it's not quite 10%, but that's pretty big. And of that 15%, a lot of it was today.
Agreed. To me, this is an inflection point where we pulled back to that 20 SMA. So we're in an uptrend. This is a pullback to the 21 SMA. This is an inflection point. Are we going to bounce off of that and go back up and make new highs, or is this just going to break down like it did every other time we made an all-time high?
Right.
So,
and that volume idea, the volume smile. Crypto doesn't really have a floor trade, right? Because it didn't trade in the pits, but you do see these spikes a little, coming in on these big bars. So maybe we're seeing that, yeah, but this is accumulation, and buyers are saying, let's take this out. This opening range high, though, We have to get above. We have the VWAP to get above. So there's a couple obstacles before we can say, you know what, we're going to hold above that moving average.
I totally agree. Any market you want to look at, Tom?
Yeah, you know what? I did want to look at bonds. So let's look at bonds on a daily chart first, because we haven't done that in a little bit.
10-year?
10-year. I'm sorry, you're right. 10-year. I think of bonds as a market rather than a specific contract. So this is the 10-year note. It's priced in actual price, not yield. And what we're seeing is yesterday we finally traded below this recent support area from earlier, well, in February. And we can use a rectangle to see what that would have looked like. And I kind of would have put it right here. We traded in, but right now we're trading back out. We never got really too oversold. So kind of, you know, not really directional move, not really great trend, kind of coming back up to RSI is ticking up with the price. So that's kind of in line. I don't see a lot of divergence. Yeah, slight higher lows on the RSI for slight higher lows, I should say, versus slight lower lows, but nothing pronounced. The volume as we would expect going into an FOMC announcement day is lower. So this is kind of, you know, interesting, but it's not, I don't think there's a lot of volume to support whatever's happening. It's kind of a transitory couple of days. So, you know, the market doesn't, the bond market, treasury market, the 10-year note market doesn't seem to have an idea of what the direction will be, because it's waiting for tomorrow's announcement. That's kind of my point. It's rare that we see, you know, kind of the notes waiting, but they do wait before these kind of events.
Agree. I mean, if you look at the ATR, you know, basically volatility starts decreasing, you know, a month before the FOMC each cycle. And it's not like a huge drop off in volatility, but just a slow trickle as you notice the little candles get smaller and smaller as we approach FOMC. You know, it's interesting. Larry was talking about the fact that he likes to trade 30-year bonds. And, you know, in my mind, the 30-year bond is more of a strategic swing trading type instrument where most traders where the action is more tactical. Intraday trading is done here on the 10-year.
Yeah, and I think it's volume, right? The 10-year is the most highest volume contract, I believe, on the CME. We're not at 1 million yet today. You can look at my market analyzer. If you have good eyes, you might be able to see that. I'm highlighting the volume here. 1 million, not even 1 million seems a little light by this time of day. But interesting here, I'm looking at cumulative order flow, cumulative delta. And during this run up, we had a net of sellers come in, and the market hasn't really retraced too much. I mean, it did have a little bit of a downtrend, but we're kind of hanging out there. So I don't know what that means. To me, that seems to me that this could be a topping action unless we start to see buyers come in. But we don't have those buyers coming in. It's sellers or mixed, and you know, that tends to, I think price tends to follow what happens in cumulative flow delta or order flow cumulative delta. So I think this might be an area that we might see a breakdown below the point of control.
Yeah, I agree with you. It's you know, this is a market that is often driven by news, right? We see this market move on the big news announcements. Anything that is that could give you a hint of what's going to happen with inflation or with employment can move this market. And I think we're at a point now where there isn't a lot of that news. And I think this market is going to tell us here in the next couple of weeks where that longer term trend is going to be. Yeah.
I agree with that. And you know, is there anything you want to look at, Mike?
I was looking, there's a couple interesting things. Let's look at crude oil. I think this market is getting to a point where we could see some hedgers come in here. I'm looking at the let's look at the daily to start.
Got it. Let me bring that over here.
So we've been up, we've been up. I'm going to count that little doji on Friday as an update. So we've been up 5 days we've been up 5 days in a row here. Where we toyed with 83 today. That is, the last 3 out of the 4 sessions have been the highest closes going back all the way to November. So if you're a hedger, if you have crude oil in the ground, you're thinking, okay, I want to sell some of the crude oil I have in the ground. You're going to do that by selling futures. This isn't a bad price to do that. You could lock in $83 a barrel. That's a pretty good profit. Let's say it costs you $50 to $60 to produce a barrel of oil nowadays, with transportation and everything. So that's pretty good. That's a pretty good profit. So, but the thing is that these guys are super smart, right? I mean, the commercial hedgers know the market better than everyone else. They know the supply and dynamics better than everyone else. So by watching, crude oil, watching that price action, you're actually getting inside the head of those big commercial traders. So I'm not ready to call a top here, but I'm just saying that as we move forward, I would not be opposed to a short trade here. Where an intraday short trade, by the way, not a swing trade. Let's be clear here. I would never be short crude oil overnight, because anything major geopolitical could spike this market up and wipe out your account. So you never want to be short crude oil overnight. That's just crazy right now, I think, in my mind. But you can pick spots to be long. I just don't think this is the spot to be long. I think we're in high. These are high prices where hedgers could come in, but intraday, I could see looking for some short-term pullbacks in this market as hedgers come in.
Yeah, that makes sense, right? You don't want to fight the trend. When you call it swing trading, you're talking about possibly 1 to 2 days, maybe longer, on a trade, which, of course, like you said, with geopolitical events being what they are, that's a lot of risk to put on. Even if you put in a stop, we know that if something catastrophic happens, market could blow through your stop. You want to be very careful, and the best way to do that is not have a position on overnight. But Mike's talking about intraday, and so looking at the intraday chart, what I see here is an interesting chart, because point of control happened way down here as the market was consolidating, right? The market pretty much stayed underneath yesterday's close. It's just shy, held as resistance, was tested a couple times when Europe came in, and pretty much stayed there all the way until, really the market open in the US. Even after that, right? It was about 9:20 that has made a big leap. And that's the interesting thing, I think, Mike, about order flow volume profile is you could have a point of control from the Asian session and the European session. And because it's a global market, there are, more of the volume, I should say, is disproportionate or is afforded to those 2 sessions on a percentage basis than, let's say, stock index futures. So that when we do get the US market open, yeah, it's a big move up, but we still don't have a point of control. So what do? I think you look at the next competing one that occurred during the US Open or after the US Open. And so, top of the value area, but right there, that's a competing point of control. Maybe it is a pullback there to go long, or maybe you think you've made a top here. Although it's hard to say that we're in a top when we just have one piece of evidence, which is this very long wick at the top. I don't know. It seems pretty bullish. It's hard to go short when we don't have a lot of evidence. But if you did, you might find some purchase right there. There seems to be a lot of wicks ending there, wicking through, a lot of trading at that level, right around 82.58 or so.
Yeah, I think those pullbacks in an uptrend in this market, I think that is an interesting play intraday, because again, intraday, you know, you have a little bit lower risk, but there's that let's go up, let's come back, let's go up, let's come back. So I think there's some opportunities in both directions here intraday. Interesting point you made on point of control, and that is that if you look at that point of control, really it's volume. It's really derived from volume for the most part. So overnight, you have a point of control, usually on lower volume. And then when the US traders come to work, they start trading, you see that point of control moving up to whatever that new spike is. And but in crude oil, it's interesting that point of control lasts longer than like in the major market indexes. But the thing to remember is wherever the point of control is right now doesn't necessarily mean that's where it was historically. So you always look to the right on the point of control and look to the left with a grain of salt, asking yourself, was that really where it was historically?
Exactly. And the same is true for the value area, right? And any of these studies that adapt by with new information, right? VWAP is the same way. VWAP bands, just because it crossed here doesn't mean that that's where the VWAP band was when price was up there. It might have been a little higher. So very, very true with these adaptive studies that, it's the print at the end of the candle that you see, not necessarily the intraday behavior during that candle.
Totally agree. So Tom, we have a couple of interesting things happening tomorrow. Bobby Iacchino will be here talking about the implications of the FOMC. He's kind of the preview to FOMC versus your and Jim's event where, you'll be actually living it in as it's happening. And then you have a special guest, Mike Arnold, who talks about his approach to blending different ideas. And I'm sorry, not blending different ideas. I meant to say building harmonic support and resistance levels.
Yeah, and fun fact, Mike and I went to the same high school. He's 2 years younger, but we went to the same high school. It's kind of a small world, but yeah. So looking forward to talking to Jim will be talking to Bobby. I'll be talking to Mike. We have that special event at 1:45 for clients only. So yeah, tomorrow will be all about the FOMC. I'm pretty sure.
Definitely. And of course, Jim Cagnina will be on Bar's Closing today at 3:15. So don't miss that. And as I said earlier, if you missed any of the special guests we had, Dan Gramza, Blu Putnam, Larry Williams, this event will be posted on YouTube in the Learn Center in just a few minutes after we finish up here. So definitely go back and watch that replay. I think I'm going to watch it. I watched it the first time. I think I'm going to watch it again. There was a lot of great information there. So thanks everybody for joining us today on Ninjatrader Live and joining us here for the midday wrap up. Tom, thanks so much for being here.
Mike, thanks for having me. And as always, it's great to work with you on the charts. Looking forward to doing that more regularly, and want to thank the viewers for coming too, seeing our guests, seeing our analysis, and hopefully you can join us later at Bar's Closing.
Thanks everybody for joining. We'll see you at Bar's Closing, and we'll see you tomorrow. Have a great evening. Good luck in your trading.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of Ninjatrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the Ninjatrader website.